Atori, hello, hello.
Actuaries may not be able to prevent these crises from occurring, but at least they are the ones to predict their costs in advance. Their work underpins the stability of numerous essential systems. Without them, the world could face a range of catastrophes, stemming from financial instability, collapse of insurance industry, underfunded critical infrastructure, and mismanaged global risks. In a world full of risks, actuaries are a crucial line of defense against financial chaos.
It's my pleasure to invite to stage Mr. Ibrahim Khalil Ibrahim, CEO of Mina Money, for his opening remarks.
Assalamu alaikum. That video was for a warm-up for the conference, but if there was one more risk to add to that video, it would have been geopolitical risk, both old and new. I think without which, maybe we could have had 60 more participants in the room today. Anyway, good morning, Excellencies and our distinguished delegates. Good morning to you all. And we are proceeding today with the 4th edition of the Arab Actuarial Conference, and I can see many familiar faces who have witnessed the 4 editions of the Arab Actuarial Conference. We are so grateful for your presence, for each and every one of you, and I believe you are such a great industry. The actuarial and insurance brains of the world, they directly manage and influence in excess of $100 trillion around the world. It might seem big in the macroeconomics of number, but 100 trillion, if you take the pension industry, both private and public, that's around 60 trillion. Globally, the global pension assets is around, it's 59, so it's almost 60 trillion. If you look at insurance assets around the world, the global insurance assets, that's $36 trillion. If you look at the global healthcare spend, that's $10 trillion. If you look at the combined revenue of the top four audit firms, they have, of course, 50% of their total annual revenues comes from consulting and advisory. That is risk, that's what you do. They have 212 billion in annual combined revenues. Half of that is on advisory and consulting, which is around risk. If you look at the actuarial trio, the Milliman, the Mercer, and Willis Towers Watson, that's something like 17 billion in revenue. And so if you combine all these revenues and assets, the actuarial, the insurance brains, the talents, the structures, you manage a quite significant assets for the world. Your work is so essential, as we have seen. So in Mina Money, we are, of course, not a risk advisor. That's for you to do, and that's you are the great talent to do that. What we are is we are into thought leadership. We are driven by curiosity. We track the key changes, the big insights, the major reforms, and the forward thinking in systems that affect the economic and social resilience of both local economies and societies. But of course, Mina Money could not have done this as a one-man show. The approach is always we engage and we partner with the ecosystems, the insurance federations, the regulators, the central banks, and whether it's in pension or financial literacy or health insurance or actuarial work, we focus on the insights, on the emerging themes, and we cover them and we give them perspective. And that's why our job is to create the platforms that are helpful, that are instrumental to your growth and to your narratives, because each one of you has a strong business narrative. Whether you are an international actuarial society or a central bank or a financial regulator or an insurance provider, you need to engage, you need to be updated, and you need a marketplace, you need a platform. And we have recognized that in this region, we have been missing a solid, robust, and rich actuarial platform. And thanks to one gentleman, he sits quite in the corner there, Dr. Adil Munir. This was his brainchild 5 years ago. In Sharm el-Sheikh, we met in 2022 with Dr. Ma'id. And he says, Ibrahim, you do good stuff. Let's do an actuarial conference. So it was his idea. Thanks. He deserves an applause. His Excellency Dr. Mohammed Ma'id, who was then the Minister of Finance of Egypt, and he is one of the most capable pension architects and actuaries and qualified actuaries. He helped us establish this, and he officially opened this conference back in 2023 in Cairo, and he is opening the 4th edition today in Dubai. Again, this wouldn't have been successful if it's not for the strong partnership and support we are getting from our partners. This time the host is the UAE Insurance Federation, represented here by Al-Akh Farid Lutfi. He is the Secretary General of the Emirates Insurance Federation, and Al-Akh Hussein Sharbini. But also we have a permanent partner in the organization of this, which is the Arab GAF, which is the Arab General Insurance Federation, represented by our dear brother Al-Akh Shakib Abu Zaid. And also we should not deprive people of their due. This time, at least this time, and also in the previous editions, we've had big hand and support from the founders of the Arab Actuarial Society, Mohammed Suleiman, Mohammed Shimi, and his colleagues. And we will continue to grow, and we are an open-ended platform, and we hopefully build a narrative that helps the regulators, the region, the industry, bring perspective, bring issues, and create debates that keeps them thriving and growing. Thank you, and enjoy the conference. Thank you.
Thank you very much, Mr. Ibrahim. And it's now my pleasure to invite to stage Mr. Khaled Chairman of the UAE Insurance Federation, for his opening remarks, represented by Farid.
بسم الله الرحمن الرحيم. السلام والصلاة على أشرف المرسلين الله عليه وسلم نبينا محمد. Every major decision shaping our world today, economic, social or environmental, shares one common thread: uncertainty. And it is precisely here that the actuarial profession finds its purpose. Your Excellencies, distinguished specialists, honored guests, respected colleagues, ladies and gentlemen, good morning and a very warm welcome. It's a great honor and pleasure to welcome you all to the world from an actuarial eye. A conference, a gathering of professionals brought together to explore how we measure, understand, and manage uncertainty in an ever-changing world. Today we are living in a time of unprecedented complexity, economic volatility, demographic shifts, climate risk, technological disruption, and rapidly evolving financial systems are reshaping societies across the globe. When viewed through an actuarial lens, these challenges are not merely risks to be feared, but opportunities. Opportunities to apply an analytical thinking, data-driven insights, and sound professional judgment to support better decisions and more sustainable outcomes. There is no doubt that actuaries play a vital role in shaping resilient economies and protecting societies. Our profession stands at the intersection of risk, data, and strategy, helping organizations and governments navigate uncertainty with confidence and responsibility. Through this conference, we aim to exchange knowledge, share experiences, and explore how actuarial science can continue to evolve and add value across industries, sectors, and borders. I would like to sincerely thank our sponsors, moderators, speakers, organizers, and participants for being part of this important gathering. Your presence here today reflects a shared commitment to excellence, innovation, and collaboration, and aims to help develop your business strategies. As we begin this conference, let us remember, when uncertainty grows, the value of actuarial insight grows with it. May the conversation we start here today help shape a more resilient, informed, and sustainable world. Let us use this opportunity to learn from one another, to challenge ideas, and to view the world through a sharper actuarial lens. We live in a world defined not by certainty, but by how we will understand and manage risk. That responsibility places the actuarial profession at the heart of global decision making. The conference provides a vital platform to sharpen our thinking, to strengthen our collaboration, and reaffirm the essential role actuaries play in turning uncertainty into an opportunity. I wish you a productive, inspiring, and successful conference, and I thank you for the privilege of your time. And now let us start. Thank you.
Now my pleasure to invite to stage Mr. Shakib Abu Zaid, Secretary General of GIF, for his opening remarks.
And gentlemen, Your Excellencies, His Excellency Mr. Dr. Mohammed Moaid, His Excellency Mr. Farid Lotfi, Mr. Ibrahim Khalil Ibrahim, and Your Excellencies, distinguished guests, it is my pleasure to welcome you to the International Arab Actuarial Conference 2026, which since it launched in 2023 has become a recognized regional and international platform for Arab actuaries under the theme, The World from an Actuarial Eye. Since the establishment of the Arab Actuarial League under the GAIF umbrella and building on the three successful previous conferences, this gathering highlights the growing importance of actuaries in supporting financial stability and advancing the efficiency and sustainability of Arab insurance markets amid rapid economic, technological, and demographic change. I would like just to mention that 4 years ago, when we started the Arab Actuarial League, we were not expecting, to see such events developing, and we did not see how the actuarial profession is growing, and this is something very positive, because I remember when in my previous life I was visiting companies, we could find rarely one or two actuaries in few companies. But today, thank God, we do have actuaries, and especially in countries like Saudi Arabia or UAE, we can see in each and every company actuaries, and also in some other countries. Also, we do have initiatives here and there. In Egypt, the American University of Cairo and the Insurance Federation of Egypt is also has started a program to educate or to prepare future actuaries, and this is something very positive. The same with the Cairo University. The expanding role brings professional and regulatory challenges, most notably in developing national and actuarial talent, aligning with international standards and strengthening integration and knowledge exchange across Arab markets. We view these challenges as opportunities for sustainable development. In recent years, several Arab governments have increasingly recognized the strategic importance of the insurance sector as both an economic driver and a core pillar of financial and social protection. This has been reflected in a wide-ranging regulatory reforms across countries such as Egypt, Morocco, the UAE, and Algeria, as well in Saudi Arabia, comprehensive insurance sector development strategy. I think 2 weeks ago, the insurance authority in Saudi Arabia launched the strategy for the insurance industry, which is really a very ambitious strategy, signaling a common direction toward more efficient, transparent, and sustainable markets. These reforms have elevated the role of actuaries beyond traditional pricing and reserving functions to encompass governance, risk management, regulatory compliance, and strategic decision support. At the same time, the insurance sector is undergoing profound transformation driven by technological advancements, artificial intelligence, and demographic change. Addressing challenges such as the IFRS 17 implementation, solvency requirements, natural catastrophe risk, and longevity risk require stronger data capabilities, advancing tools, and agile actuarial thinking. Despite accounting for only 179 of global insurance premium, the Arab region attracts growing international interest due to its population of 450 million, strong economic fundamental, and a substantial protection gap estimated at 86%. This potential is already evident in leading markets such as Saudi Arabia, UAE, and Morocco. The increasing number of regional conferences and professional forums has further strengthened the global presence of Arab actuaries and reinforced their role in supporting sustainable market development. Ladies and gentlemen, these developments place upon us a shared responsibility to continue advancing the actuarial profession, investing in talent, and enhancing regional and international cooperation. We hope this conference will serve as a platform for meaningful dialogue and practical insight and contribute to a more resilient and sustainable Arab insurance sector. To the young actuaries among us, the future is yours. Embrace innovation and lead this transformation. In closing, I would like to extend my sincere appreciation to Mina Moni, to the Insurance Federation of UAE, and to all the partners and sponsors and the panelists and experts for their valuable support. And we trust that this conference will add tangible value to our region development journey. Thank you very much.
Thank you very much, Mr. Shakib. It's now my pleasure to invite to stage Mr. Paul Sweeting, President of the Institute and Faculty of Actuaries, for his opening remarks.
Assalamu alaikum, sabah al-khara, and welcome distinguished guests, Your Excellencies, and I believe some of my undergraduate students who are attending the conference as well. It's a real pleasure to be here today to address you all in Dubai, a place which it's my privilege to call home, and it's been wonderful living in the region for the last 8 years to see the development of the actuarial profession here. I've lived in Dubai and in Riyadh since 2018, and the development has been immense. You can see this in the range of opportunities and the importance attached to actuarial and insurance work in particular by countries across the region. They recognise that strong economic growth isn't possible without a strong insurance industry, and you can see that the policies across the region are designed to support this industry, to support economic growth. You can see this in the development of the non-life, the property and casualty industry across the region. You can see this in the growth of motor and health insurance, which has consistently developed across the region, but also you can see it in changes such as the tendency to move away from the end of service benefit towards an insurance type fund. Recognition that actuarial principles, actuarial techniques are actually essential for the growth of the economies across the region. And you can also see it in the development of actuarial courses in universities across the region, that the huge growth in the number of actuarial students coming out of the universities, which is going to support the growth in a way that means it's not just a case of importing actuarial talent from outside, but it's a case of growing actuarial talent within the region, which is really important. Now, one of the questions that I get a lot when I'm talking to groups of actuaries is, are we producing too many actuaries? Is there going to be enough work for them going forward, particularly with the development of AI? And I think back to times before I became an actuary, when they moved away from just using pencils and slide rules to using calculator machines, and wondering if this new technology was going to do away with actuaries, or when pocket calculators were introduced, was that going to be the end of the growth of actuaries because you didn't need people to do all these handwritten calculations? Or when we moved to mainframes and then to desktop computers, to laptops, to being able to do calculations on your mobile phones, do we really need all these actuaries when calculations have become much simpler? And with each of these new developments, the number of actuaries hasn't shrunk, it's grown, because these new techniques mean that we can do more. We can answer a broader range of questions using these new technologies. And AI is a particularly interesting development because it's so complex. It requires people who understand exactly what's going on in these models, people who are able to apply professional oversight to these models, and people who are able to explain what's going on in these complex models to non-specialists. In other words, it means actuarial work, because that's what we do. We look at complex models, we work with these models, we understand what's going on, we explain what's going on to people who aren't specialists, and we do it by applying professional oversight. So generally around the world, the demand for actuaries is going to grow. Specifically in this region, the demand for actuaries is going to grow, and the skills that we have are going to be hugely sought after over the coming decades. So, as I say, it's a real privilege to be here to speak to you all today. I'm very much looking forward to the sessions that we have planned, and I look forward to meeting many of you through this conference. Thank you very much.
It's my pleasure to invite to stage Mr. Mark Stewart, Chief Executive of Dubai Financial Services Authority, for his opening remarks.
Your Excellencies, distinguished guests and colleagues, ladies and gentlemen, good morning. I hope you're all well. I will try and be as brief as I can in these opening remarks. Modern financial regulation, and I speak as a financial regulator here in Dubai, is avowedly risk-based, so one would expect us financial regulators to have a great deal in common with actuarial practice, especially the assessment and measurement of risk. Whilst our regulatory framework leans heavily on actuaries, and we have actuaries who work for us, especially for capital adequacy, asset liability management and event frequency, I'm not sure as financial regulators we are as attuned to the disciplines of actuarial practice as we might be, could be, or should be. I've often thought that regulators tackle regulatory risk need more actuarial discipline and passion, and we in fact do. At the same time, financial regulators are dealing with a range of different risks as well, perhaps without the same richness and granularity of data that actuaries are often used to dealing with. The financial weather can be affected by so many random, unsystemised interventions and activities, which makes risk identification especially challenging.
Great honour to be here today in the United Arab Emirates, representing the global actuarial profession. I'd like to sincerely thank our hosts, including the Arab Actuarial Society and Mina Money, for the invitation and for organising this important conference. For those who may not be familiar with the International Actuarial Association, or the IAA, we're a non-profit organisation founded in 1895. Today, we're the Global Association of Actuarial Associations, representing over 90,000 actuaries in over 115 countries. Our purpose is simple yet vital: to support and advance the actuarial profession worldwide, always in the public interest. Our work has a meaningful impact on the global stage. We engage with key supranational institutions, such as the International Association of Insurance Supervisors, the International Organisation of Pension Supervisors, the International Social Security Association, the OECD, the World Bank, and many others, to provide actuarial expertise on issues of global importance. We're committed to promoting the actuarial profession everywhere, supporting our member associations in developing and ensuring high standards in both education and practice. The IAA is also dedicated to advancing the competence of actuaries worldwide, fostering scientific knowledge and strengthening the skills that underlie our profession. We organise high-level capacity building initiatives, including training programs for regulators. We deliver this training together with the host countries and partners to reflect local priorities and needs. Most recently, we held a program in Morocco last November delivered in French, with participation from several Francophone African countries. We see strong potential to offer similar trainings for regulators in the Middle East, including programs in the Arabic language. And with that in mind, our presence here reflects the IAA's strong interest in this region and our commitment to supporting the development of the actuarial profession. We're here to listen, learn, and better understand local priorities and challenges. And finally, I'd like to emphasise that building actuarial capacity is an investment in a strong and sustainable future for both the profession and the region's financial systems. So please feel free to reach out either during or after the conference. We'd be delighted to meet, exchange ideas, and explore ways to work together. Thank you, and I wish you all a very successful conference.
It's now my pleasure to invite to stage Mr. Giral Jakundi, Deputy Managing Director of the Bermuda Monetary Authority, for his opening remarks.
Distinguished guests, ladies and gentlemen, good morning. My name is Gerald Kakundi. I come from the beautiful island of Bermuda in the middle of the Atlantic. I'm not quite sure why I'm here helping open this conference. Maybe that is because Bermuda has the highest per capita actuarial presence. In fact, Bermuda, I'm told, is the only place in the world where you take a taxi from the airport and the taxi driver talks to you about actuarial services, which is rare. It is both an honor and a privilege to join you here in Dubai for the Arab Actuarial Conference. This is my first visit to this vibrant city and the United Arab Emirates. At the BMA, we have long admired from afar the remarkable progress and dynamism of the UAE's financial sector, and it is especially exciting to engage you in person. Now, we gather here at a time when the world is grappling with unprecedented volatility. Among other things is the risk of climate. We are also seeing sort of profound demographic changes, big changes in how people live, whether that's from a healthcare perspective, growing frequency and intensity of climate-related hazards. The reason I share this, and the video that was shown earlier on, it did put the fear of God in me, but it is also the truth of what is likely to happen. The reason I share this is because all this volatility and the risks can only be solved through, there's not one single method of solving this volatility and risk. However, capital and innovation can go a long way in helping with this solution. Capital and innovation can go a long way in helping bridge the significant protection gaps that exist around the world in uninsured communities and uninsured people. It is not the only answer, but it's a cornerstone of the solution. So this profession plays a vital role in the ability to innovate, in the ability to look at risk and find innovative ways of modeling that risk, pricing it, and allowing capital to come in and be able to underwrite the risk. That is what Bermuda has done. This profession also helps with facilitating the diversification of risk that is needed in order to allow the management of risk and allow coverage to increase. Insurance is a solution, and it's not the only answer. It does provide resilience to individuals and institutions that helps to withstand the shocks. At its core, insurance achieves this through diversification and capital. In this context, global financial centers such as Bermuda
the Dubai Financial Services Authority and Abu Dhabi Global Market are uniquely positioned as solution providers. We have a shared commitment to robust regulation, innovation, and openness to international capital markets. I will share more in an upcoming session about Bermuda and about our markets. But in closing, I'm inspired by the spirit of collaboration that brings us together here today. By sharing our expertise and forging partnership across borders, we can meet the challenges ahead and shape a secure and prosperous future for the world community. Thank you for your attention, and I look forward to an engaging and productive conference.
Thank you, Mr. Giral. And now, last but not least, please welcome His Excellency Dr. Muhammad Maid, Executive Director for the International Monetary Fund, for his final opening remarks.
السلام عليكم ورحمة الله وبركاته. صباح الخير. Let me start by thanking Mr. Ibrahim Khalil for inviting me for the fourth edition of this beloved conference. I was honored to be available and open the first one. So today is another day for me. Let me start by saying, ladies and gentlemen, distinguished guests and fellow actuaries, good morning and welcome all of you here in the dynamic and inspiring city of Dubai. It is a great honor for me to take part in the opening ceremony of the International Arab Actuarial Conference 2026, hosted in this global hub of the Middle East. This conference is a unique professional platform that brings together actuaries, firms, government officials, and industries from across the Middle East and Africa, united by a shared commitment to advancing actuarial science and practice and their impact on insurance, finance, banking, healthcare, pensions, public finance, and risk management. This year's conference theme, "The World from an Actuarial Eye," perfectly captures the essence of our profession. Actuaries have a distinct lens through which we view the world. One that combines rigorous analysis, forward-looking insight, and a deep understanding of risk and uncertainty. And let me say, uncertainty is the most important now. We're going to live with uncertainty for a long, long time to come. So, through this lens, we have shaped resilient societies and sustainable economies. Actuarial science and practice are much more than numbers and models. It is a vital discipline that enables individual organizations and governments to prepare for the future, in particular, the continuous and increasing uncertainty with more confidence. Actuaries assess and manage risks that affect hundreds of millions of people, from retirement security to healthcare access. One of the most important topics in this conference is social insurance, particularly pensions and medical insurance. These programs are the backbone of social and economic and also physical sustainability and stability of any economy. Providing financial protection and peace for the people across the region for their future. In pensions, actuaries face the challenges of balancing demographic realities. And to be honest, the IMF started to recognize such huge risks to physical sustainability of our budgets. And last April, if you look at the report issued by the IMF, there was a unique chapter about such risks on the stability of our budget and the financial situation. So, as I said, particular pension and medical insurance, these programs are the backbone of social and economic stability, providing financial protection and peace to the people in the region. And pension actuaries face the challenge of balancing demographic realities such as aging populations and increasing longevity with economic factors like investment returns and inflation. Actuaries' role is to ensure pension funds and social insurance remain sustainable and capable of meeting their promises to retirees now and in the future. Yesterday, I was in a meeting, the managing director and some ministers of finance, and she said, now we have to ensure that pension reform is going on, because unless you are able to finance, it will hit hard to the budget and the fiscal sustainability of countries, particularly those with having double problem, not less fertility, but high fertility. And not less mortality at aging, but low mortality. So they need employment. At the same time, they need to allocate more money to look after those who are living more, looking for more health care. And if the economy is not able to produce enough growth to create jobs and to spend on this impact of longevity, again, it will be a problem for budgets of the countries in this region. In medical insurance, actuaries analyze health risks and cost trend to design insurance products that are both affordable and comprehensive. We support governments and insurers in managing the rising cost of health care while striving to maintain access and quality for all. Let me say, some countries like Egypt introduce universal health insurance as a very promising scheme to provide health for the whole population. But the challenge is the financial sustainability. And I think when we designed this system, we put an article in the law that it has to be reviewed at least, it has to be actuarially reviewed at least once every 3 years to ensure that it will be financially sustainable. Otherwise, I remember I worked with many ministers of finance before me. They were refusing to do it because they said it will be very dangerous to the physical sustainability of the country if I have this universal health insurance. This conference agenda reflects the breadth and depth of these challenges and opportunities. Over the next 3 days, you will have explore critical topics such as global insurance, regulatory landscape, the transformative power of AI, and this is a challenging, a huge challenging. My advice to you is that you need to work more and more very quickly on AI. We are coming in Washington, just 3 days retreat, and the concentration was on AI. AI is moving faster than any imagination, and I believe we have to be ready for this revolution. So data and insurance and the design of affordable, acceptable and universal healthcare. You will also delve into cutting edge themes like the impact of generative AI on actuarial work, capital models and risk management for insurance and takaful business, and the sustainability of public pension funds. These sessions underscore how actuaries are at forefront of innovative, adapting to new technologies and evolving society's needs. The conference also highlights emerging areas such as actuarial roles in banking and investment, digitalization, and insurtech, reshaping the insurance industry, and the growing importance of enterprise risk management. You will hear from leading experts and practitioners from around the world sharing insights that will help you navigate the complexities of today's risk environment. Importantly, the conference recognizes the ethical and social dimensions of our work as actuaries. We are not only guardians of financial stability, but also stewards of fairness, equity, and sustainability. Our decision impact real people's life, and this responsibility guides everything we do. As we look through the world from an actuarial eye, we see a profession that is evolving rapidly, embracing advanced analytics, machine learning, and AI to enhance our predictive capabilities and decision making. We see actuaries are uniquely positioned to guide government, insurers, employers, and society at large through the complex challenges of the 21st century. Our expertise ensures that social insurance programs remain robust, fair, and sustainable amid uncertainty and change. I encourage all of you to engage fully in these sessions, network with your peers, and share your knowledge and experience. Together, we can harness the collective wisdom of this community to address the pressing challenges facing social insurance and actuarial science today. In closing, I want to express my deep confidence in the actuarial profession's ability to lead, innovative, and make a lasting positive impact. This conference is a testament to our commitment to excellence and collaboration. Thank you for your attention, and it is my great pleasure to officially participate in this opening of this International Arab Actuarial Conference 2026 here in Dubai. Thank you very much. Salam alaikum.
I would like now to invite our first row guests for a group photo on stage, please.
To attend this important session. It's not important because I'm moderating it, because really our distinguished speakers. So, as you know that insurance market, in any country, the insurance market components is the insurance companies, the intermediate clients, and then the regulator. So the regulator really play a very big role. And the insurance regulations now is being really global in its unique role, but in fact, it's very local in the execution. So today, we're not going to compare the regulations in different places and different countries. Like we have the UAE, we have from UAE, Abu Dhabi, Dubai, and all the way to Bermuda. It's not about comparison. It's more about knowing the directions of the regulations and where we're going, which is very important for all of us. Without further ado, I'd like to start with Mary Ann. So she'll be our first speaker. She will give us her view, and then I might have some questions after you finish. Please.
Thank you so much. Good morning, everyone. Thank you so much for the invitation. We do have a presentation regarding the regulatory framework for insurance applied in Abu Dhabi global market. And before, however, kicking off, what I would like to say is that reflecting also some of the comments in the opening remarks, we're seeing huge economic growth in Abu Dhabi and the wider UAE, and that has brought with it increased interest and increased demand in the insurance sector. And we're going through a review of our regulatory framework, and I'm happy to give an overview of that. Did they put the presentation on? Yes, we sent them yesterday. Okay. As I mentioned in just now, we're seeing a lot of interest in the insurance sector, and on the back of that interest, and also in line with the economic vision and the strategic objectives of ATGM, the ambition is to develop the framework to position ATGM as a regional and beyond hub for reinsurance in particular. I'll be giving more details as to what we have been doing and what we have in plan. It's not, from a timing perspective, it's not something that we are going to do overnight. It's a process because we are looking at upscaling and modernizing our framework to make it more economic sensitive and risk-based from a capital perspective, and to make sure that capital allocation is as efficient but as risk-targeted as possible. So we started off with a discussion paper where we outlined a number of areas that we plan to make changes in relation to some key aspects. We also identified a number of other areas that are still under consideration, and other features that exist in the market in relation to which we'd be interested to receive feedback from the industry. Our objective is to develop and launch a more modern framework that is reflective of industry developments. We will be issuing a number of consultation papers over the course of 2026 and 2027. We're learning also from other jurisdictions, especially jurisdictions like, for example, Bermuda, who have a long experience in the reinsurance space, and also looking at international standards. The advantage that we have is that we do not have so many legacy issues, whereas other countries may have had a long time to put to transition, for example, to these type of frameworks. We do not have as many legacy issues, so that makes us a bit more agile in our approach.
Totally agree with you, yeah. I don't know if the presentation is ready or not yet. Not yet. So I'd like to move to Gerald, if you mind. Because Mr. Ibrahim in his opening, he spoke about one of the risks that, and also Dr. Maid spoke about it, the geopolitical risk. So geopolitical risk, the geopolitical risk and the global uncertainties that we are all living in. What are the challenges in Bermuda? I mean, I think all of us need to know if these ones are challenging or not. I mean, do you have also other challenges that you think is really important that you wanted to have the audience aware about it?
Yeah, and maybe I start with the geopolitical issue. So, for a jurisdiction like, a place like Dubai or a place like Bermuda, the reason it's been successful, or the reason reinsurance has grown is because of that ability to consolidate or to bring together risk that is global in nature. So you're diversifying earthquake risk with hurricane risk. You're diversifying, life insurance from different, sort of jurisdictions, and to bring sort of differentiated capital to cover that risk. What I see with the geopolitical fragmentation or the political fragmentation is that could at some point start impacting that sort of ease of flow of capital and risk. And if you have capital and risk not flowing easily across borders, it starts eating into the core element of risk diversification, which is what insurance is all about. But there are other risks that we are facing, and I think some of them have been mentioned here this morning. Cyber is a particularly important one. But again, the issue that we face is that all these risks are interconnected. So, if you have cyber disruption, it then starts disrupting air travel, it's disrupting manufacturing and all that. And so we are living in an era where, risks cannot be contained either in one area or in one geography. They have become truly global. And then lastly, is I think about climate and the risk there. On my trip here, I almost didn't make it because of that storm on the East Coast. And as I was getting stuck in the middle of that storm that likely is causing tens of billions of dollars of loss, I think I saw something that suggests about 9 billion of insured loss. The economic loss is a lot higher. At the same time reading about wildfire in Victoria, Australia, that is, decimating homes. So, climate risk has become quite significant. I think I was looking at some statistics that suggests the last 4 years we have seen 100 billion of insurance losses that are climate related. And this is in a period where there has been very few large hurricanes that have hit land. So all these are small events that accumulate into these large figures. So again, as an industry, how do we ensure those types of risks? Back to my points earlier, there's a need for innovation, both on the capital side, on the investment side, but also on the risk pricing.
Yeah, I agree with you. Last year, the total losses of the world was about 300 billion US dollar. 165 billion US dollar is insurance loss, which is really a big one. And although there were a lot of losses coming from the climate risk, I also noticed that the ILS market is really increasing a lot. There's a lot of money coming from Bermuda as well. I don't know, as a regulator, how do you see this?
I think ILS, or what in Bermuda we refer as alternative capital, is core. The capital markets cannot be the only source of capital for insurance, and in fact, if the insurance industry just relied purely on the capital markets, I think the price of risk would be unmanageable. What Bermuda has been able to do in the last 15 years is to find an innovative way of allowing private capital to come in, alternative capital to come in into the market, and take risk that is a bit uncorrelated with investment risk, and that has attracted a fairly significant amount of capital. Bermuda today brings in about 70% of the world alternative capital market into the insurance industry, and that helps moderate the prices, allowing for insurance to be available across the globe to communities and people.
We're ready for the presentation, but I just don't want to leave the climate risk issue without also going to the FCA. How do you see the climate risk as a supervisor? How do you see it from your point of view, and what are your plans for it?
Thank you, Mr. Ala. And first, let me please express my gratitude for the organizer for bringing this event to Dubai and giving us the opportunity to be part of it. Climate risk, as all the speakers this morning and Gerald mentioned earlier, is becoming really high on the agenda. The way we dealt with climate risk, we thought that this is not really a risk for us as a regulator, as a DFSA, to deal with it separately. What happened that we came all together, all the regulators in the UAE, including the central bank, ADGM, FSRA, the Capital Market Authority, and even some other governmental authorities like Ministry of Economy, Ministry of Finance, Ministry of Climate Change, and we decided to look at this holistically. And a few years ago, we came with a number of papers all together, setting the scene, if you would like, on how we expect from a financial service industry at the UAE level, how to deal with that risk. So during the COP that was hosted here in the UAE, COP 28, we issued principles for focusing mainly on the governance and risk management of a climate risk. For us in the DIFC, we're an international financial center, so we have firms coming from all over the world. The challenge is you have some of the firms coming from places where they are very advanced, like in Europe. On the other side, you might have firms who are still trying to understand what that means for them. So the focus is to bring climate risk to the board, at the top of these institutions, to the agenda of the boards, to make the decision makers at the financial institution think about it, decide whether this is relevant for their business model, and then assess the impact and decide how to deal with it. So the focus so far was from a governance and risk management perspective. Definitely what we've been doing more and more recently is also pushing the agenda toward integrating climate risk as part of the capital and solvency evaluation process, whether for bank, for example, through the ICAP, or for the insurance through the OSRA assessment. So that's also another area. And then finally, the piece what we're working on is also basically encouraging people to look at it from a forward-looking perspective. So trying to include this as part of their stress testing exercises each year. And the work that has been done so far is very promising. Definitely, as the speakers mentioned, this is a very challenging area because the frequency and the impact and the severity of the event that we're seeing are really very challenging to cope with the pace of these events. So there is a good thing also to look at this from a positive perspective, that these events actually are making people realize more and more the importance of climate risk. Like I can mention 2 years ago we had big floods here in Dubai, where before that no one thought that physical risk is something that we should worry about here because we don't have fires, we don't have floods. And suddenly it happened, and it had a serious impact. So it was an unfortunate event, but an event which helped us as a regulator also to highlight the importance of climate risk.
Thank you very much. I think we can start now the presentation. I'd like to ask all our presenters to stick to 10-minute max so we can have some questions. Thank you.
Good morning again, and I'll be quick as much as I can. So I'll first start by providing you with a brief high-level overview of ADGM and FSRA to put things into context, and then I'll mainly focus on giving you a highlight of our current policy work, as I've already mentioned. So ADGM stands for Abu Dhabi Global Market. For those who are less familiar with Abu Dhabi, we have, in terms of governance, 4 authorities: the Registration Authority, which is responsible for the incorporation and licensing of commercial entities; the Financial Services Regulatory Authority, which I represent today. We are the financial services regulator of financial entities, including insurance companies; ADGM Authority, which is responsible to drive ADGM's growth strategy and the development of the ecosystem; and last but not least, the ADGM Courts, which provides an ecosystem for digital courts and arbitration. And Abu Dhabi and ADGM Courts operate on the direct application of English common law. There are these 3 main bodies of regulations, all within the direct application of English common laws I mentioned. So commercial legislation, financial services regulatory authority legislation, and ADGM courts and arbitration legislation. These are some characteristics of ADGM. I will not go through these in the interest of time, but in essence, ADGM started off geographically only on Al Maria Highland, and 2 years ago we expanded over to Al Reem Island, which shows the significance of the geographical growth, reflecting also the growth of ADGM as an international financial jurisdiction. Coming now closer to home, Financial Services Regulatory Authority. We have quite a wide remit. We cover banks, insurance, money services, exchanges, asset management, trust services. We are a holistic regulator. With the standard regulatory objectives of safety, soundness, integrity of the system, financial stability, and consumer protection. When it comes to insurance, ADGM has a very comprehensive and flexible insurance framework. and we permit a wide range of insurance and reinsurance business models, including Islamic finance, MGA setups, underwriting agents, cover holders, ILSs, and insurance SPVs. And our supervisory approach is risk-based, proportionate, and engagement-led, aligned with international standards. In UAE, we do have federal restrictions in relation to limiting entities within the financial free zones to not write direct risks emanating in the UAE. So reinsurance is permitted, however, in the UAE, and that is one of the key focus areas for ADGM. So ADGM has taken on the ambition of establishing ADGM as an international reinsurance hub. And the objective is to develop a risk-sensitive, internationally aligned and proportionate regulatory framework. Our approach is to draw upon global best practices and standards, starting off by focusing on IAIS international standards, but also looking at Solvency II aspects, and also looking at key regulatory frameworks in other key jurisdictions in this space. And our aim is to draw on global best practices. So what have we done so far to do this? So we began with benchmarking, and we've also engaged a lot with internal and external stakeholders across the insurance ecosystem. In December 2025, we issued a discussion paper setting out our strategic considerations and highlighting all the enhancements that I will cover in the next slides. As I mentioned earlier, this is a modernization exercise, not a reset of our regime. And the objective is to have a framework that is more risk-sensitive, forward-looking, and proportionate, and shifting towards more focused capital allocation in the most efficient way. So our discussion paper is really set out in three sections. The first section focuses on proposals that we intend to introduce. And the main scope is focusing on capital requirements on funds and governance and group supervision. Again, this aligns with our objective of ensuring proper capital allocation. Our plans are to introduce an ADGM solvency capital requirement, which will be calibrated using a value-at-risk approach. We also plan to recognize diversification and risk mitigations across geography, sector, and products, as long as there is empirical and justified and enforceable evidence. Firms will be expected to operate also target solvency ratios approved by their boards. We also plan to introduce minimum capital requirements acting as hard floors from a solvency perspective. We also will be introducing requirements related to own funds. This is we plan to introduce the different tiers of different types of capital, And the objective here is to strengthen the mix of capital that insurance companies can hold. And we're also setting out a number of proposals relating to group supervision, governance, reporting, and disclosure requirements. This will help to increase transparency and strengthen also cross-border collaboration. As part of the capital requirements, we will also be considering both standard formula and internal model approaches. So through this section, we are putting a strong focus on capital quality, loss absorbency, and not just solvency percentages. In the second section, we then outline areas that we are considering. However, we are seeking further input in relation to these areas. I'm not going to go through all of these areas. However, the focus here is to consider capital calibration aspects. Again, the use of sidecars, ILSs, asset liability matching, enhancing capital structuring with the potential to expand asset eligibility to facilitate investment into certain sectors and assets in UAE, prudent person principle. Again, these are all intended to be brought into the framework and subject to additional consideration to ensure more capital allocation flexibility and efficiency, but at the same time maintaining risk sensitivity and ensuring that proper allocation is effected. Last but not least, these are also other features that we see in the market and which have been highlighted by a number of stakeholders that we have talked to. And these are additional areas in relation to which we are asking input as to whether these should be brought in at this stage or at a later stage. These are more forward-looking aspects. Again, these are areas where industry input will shape the next phase. They are not immediate rule changes. And again, these are areas reflecting the evolving market practice. And the focus here is on genuine risk transfer, capital resiliency, and avoidance of arbitrage. So we, as mentioned, we have already issued the discussion paper. It's still in consultation phase. So we welcome any feedback. The deadline closes 16th of February. And especially these are like areas of that require direct actuarial input. So we've already received substantial feedback, but we do welcome any thoughts and views that you may be in a position to provide us. Once the feedback consultation closes, we'll obviously review the feedback. We will re-benchmark and come up with policy proposals that we will be launching through different consultation papers. And then obviously once consultation process is over and done, we will implement. So thank you so much for your attention, and further information can be found from these links.
Thank you very much, May.
And I'm not sure if the slides are on. I don't see them, so in the interest of time, I know I was gonna maybe speak about the Bermuda Monetary Authority, what our mandate is, share a little bit about our supervisory approach, about the ecosystem that is the Bermuda market, as well as some of our views on emerging risks, including some of the risks that I spoke about earlier on. So, who is the Bermuda Monetary Authority? The Bermuda Monetary Authority was established in 1969, and we operate independent of the government. This independence is crucial to maintaining our credibility as a regulator and the objectivity of our regulatory mission. The Bermuda Monetary Authority does not just regulate or supervise insurance companies, but we are an integrated regulator with a much broader market. We oversee also the banking sector, our trust companies, our investment funds, digital asset businesses, corporate service providers, and fund administrators. We also manage the Bermuda national currency. We are not a central bank, but we manage the currency and assist in fighting financial crime. Now, Bermuda, we have a clear mandate, and our mandate is threefold as a BMA. The first one is to protect policyholders. We also contribute to financial stability and foster responsible innovation that helps narrow global protection gaps. We have a strategic role for Bermuda, and we see Bermuda-based insurers as playing a critical role in protection gaps, especially when it comes to natural cat, pensions, and retirement savings. You know, some of the challenges that we spoke about that affect communities worldwide. The development of our framework has taken a number of years, beginning all the way from 1978. What was presented earlier is a process that we went through in the early 2000s, and we continuously enhanced our frameworks, coming up with a risk-based framework that is not only in compliance with core principles of the IAS, but also one that has over the years been deemed to be equivalent to some of the sort of global larger regulators. Indeed, in the year 2010 or so, Bermuda earned Solvency II equivalence, and we are also considered a reciprocal jurisdiction by the US NAIC. Now, these two are important because they help Bermuda reinsurers, and I would like to say Bermuda is almost primarily a reinsurance market. We have very few primary insurers, but they help the companies in Bermuda reinsurance market be able to write business in both Europe and the US without needing to post collateral for them to be able to do that. Now, looking ahead in 2015, we are seeing that we are going to be making a few enhancements. One is to group supervision, as well as paying a lot of attention to business continuity and cyber resilience. So what is the Bermuda approach to supervision, or the BMA approach to supervision? We at the Bermuda Monetary Authority believe in high quality supervision that goes beyond just enforcing rules. Our approach is fairly risk-based and outcomes-focused. We try to be firm but balanced, robust, but to carefully calibrate our frameworks with every action aiming at addressing actual risks and upholding market integrity. Indeed, while we are a Solvency II equivalent and while we are reciprocal jurisdiction by the NAIC, we do not, or we have not implemented either of the two systems. We have a framework that is uniquely Bermudian and a framework that focuses on the specificities of our market, which is a wholesale market and more of a reinsurance market. Indeed, our framework is has some similarities to Solvency II, including the three pillars that you see. One being the quantitative pillar, where we have an economic basis of valuation for both assets and liabilities, and an enhanced capital requirement that ensures our companies can absorb shock. We also have pillar 2, which is the qualitative aspect of our framework that focuses on governance as well as on risk self-assessment. And then a pillar 3 that is focused on transparency and disclosure. Indeed, the companies in our market are required to publicly disclose their GAAP financial statements, financial condition report, and for our large life sector, we are now moving towards a framework where they will be required to disclose, very similar to the US NAIC, a listing of their investments holdings. So what is the Bermuda market like? And here I will seek to share some statistics, because over the 70 years that the Bermuda market has developed, we have tended to really specialize on insurance. In fact, we do not have many international banks, banking in Bermuda. We do have 3 banks, but we don't have international banking in Bermuda. So we are predominantly a reinsurance market. Indeed, when you look at the size of our market, we have annual premiums in 2024 of about 355 billion. About 200 billion of that is in the life sector, 155 in the P&C sector. 30 billion of that in the P&C sector is premiums from our captive insurance sector, which again is differentiated, and we have actually implemented a proportionate framework for that sector that is not Solvency II equivalent. So these numbers really underscore Bermuda's role as a major player in the global reinsurance landscape. To give a couple of other numbers, Bermuda reinsurance groups provide about 30% of the Lloyd's insurance capacity. And if you look at claims paid, I think for the last 9 years, the Bermuda market has paid about $1 trillion of claims, about 211 billion of claims paid in 2024. So, as I said, this is a market that has grown over the last 70 years. Our framework has got global recognition, but it is also a market that is very well diversified with different lines of business on both the life and the P&C sector, but also significant global diversification. We only have on the P&C side about 50% of our market coming from the US, and the other 50% is fairly global, 10% from the UK, about 9% from Europe, and the rest from Asia, including this region and the rest of the world. Now, on the life side, we do have a slightly higher concentration to the US market, with 70% of our life market coming from the US. Now let's talk about the financial strength of the Bermuda market. For insurance, resiliency and solvency, I think is everything. And Bermuda insurance companies are fairly well capitalized. The median enhanced capital requirement is about 286, which is almost 3 times the minimum requirement of 100%. And this is a powerful indicator of the financial robustness of the companies in the Bermuda market. When you look at the liquidity resilience, again, this is through our prescribed stress test that simulates a 1 in 200-year market event loss. The median liquidity ratio is 471%, far exceeding the 105% minimum requirement. Now, the one question that a lot of people have always asked is how and why is Bermuda market big, and how has it developed? And in sort of trying to explain this, I would say it's a number of factors, probably 4 pillars that anchor the Bermuda market. The first one is just historical. The Bermuda market has been providing reinsurance commercial reinsurance for well over 4 decades across both P&C and the long-term sector. I think Bermuda has had the good advantage of being close to the US, and the US reinsurance market over the years have actually been some of the largest in the world, and Bermuda has been key in providing reinsurance to that market. This is a market that has been tested through many different cycles, both large cat events as well as economic cycles, including the global economic crisis in 2008, significant events, significant hurricanes in the US. As an example, if you look at the wildfires in California early last year, Bermuda paid almost 10% of the losses coming out of that event. And you can go back all the way to hurricanes like Katrina and the others, and the market has been quite resilient across that. The second has been the access to capital and diversified investors, including what we were talking about earlier in the alternative capital markets. There has been a lot of diverse capital that has been raised from the private capital markets through Bermuda over the years. Our framework, which is an economic balance sheet approach, is one that allows insurers to value their liabilities and assets more accurately and reflects the economic reality of the balance sheet. This has been viewed as one of the important reasons why companies set up or seek to set up in Bermuda. And then the last aspect of the Bermuda market has been the intellectual capital. I wasn't joking earlier when I talked about Bermuda having the highest actuarial per capita in the world. But Bermuda also has got amongst the highest investment and asset liability matching capabilities, expertise anywhere else in the world. Partnerships that the Bermuda markets have had with alternative asset managers over the years have provided platforms that facilitate the generation of higher investment yield, which to a certain extent eases capital strain on companies and facilitates a greater product offerings. So when I look at the emerging risks, or the risks that we are looking at today, I'm not going to be repetitive because some of these we have already spoken about. I will, however, add social inflation, I don't know how much of an issue it is in this market, but it's definitely a significant issue in the U.S. market, and this is where is an area where claims management gets out of control over the years. One of the other areas that we are focused on is the growing allocation by companies in our market to private and alternative assets. At the BMA, we have sought to stay ahead of these issues through rigorous supervisory intelligence. We have regularly taken on market studies, and we have been quite generous actually in publishing the results of some of these studies, and you can find some of these on the BMA website. So, in summary, I do at the BMA we do firmly believe that Bermuda is committed to enhancing our position as a leader in reinsurance, but more importantly, we are committed to being part of the solution to global challenges. The demand for insurance to close protection gaps will continue to grow, and all of us in all different markets need to be well positioned to continue to provide those solutions. We cannot do this alone, and close collaboration with other jurisdictions is essential, and the partnerships with other jurisdictions, partnerships with the market help improve resilience and diversification, as well as transparency and innovation of our insurance markets globally. Thank you for inviting me to speak. I will end here.
Thank you very much, Mr. Thank you. So we're now on the DIFC reinsurance development and the latest regulatory development.
Sorry, I know I'm left with no time literally, but I'll be very brief as much as I can. So I represent here the Dubai Financial Service Authority. We are the independent regulator of the Dubai International Financial Center, similar to the other distinguished speakers who explained about AGM and Bermuda. We're also a principle-based regulator. The IFC is a common law jurisdiction. We follow a risk-based approach for regulation and supervision. And I'll share with you very briefly about the insurance market, reinsurance sector in the IFC, and a bit of flavor about our regulatory agenda. So very quickly, Dubai has established itself over the last 2 decades as a global hub for financial service activities. We now sit among the top financial centers around the world, and in many aspects, whether in banking, insurance, fintech, but the ambitions continue to be very big. We have, as part of the Dubai government, 2033 strategy. We aim also to strengthen our position among the top financial centers in the world. As of we speak, the IFC is currently home to actually 1,069, as of this morning, regulated entities across the whole segment of the financial service industry, including banking, asset management, private banking, investment banking, insurance, reinsurance, and so on. So to give you a flavor about the size of the insurance market in the IFC, first, reinsurance market in the IFC is purely reinsurance, so we don't have direct insurance. Across the years, this market has been growing. Actually, this morning, our Chief Executive, Mark Stewart, has shared some of the figures as well with you. The insurance market is the second growing market we have after wealth management. We currently have a total of 115 regulated entities in that sector in the IFC, covering reinsurer, captive insurance, but mainly insurance intermediaries and insurance managers and underwriters. So as much as the growth in number of firms and the players in the market is important for us, but as a regulator also, we're very keen that this is accompanied by growth in the size of the activities. And basically that's what we've been also witnessing over the years. So our numbers looks very small as compared to other places like London or Bermuda. But again, the level of growth is very ambitious, and particularly making our center as on advanced place on the stage in that region, covering Middle East, North Africa, and South Asia. So total gross written premium at the end of 2025 reached 4 billion in the DIFC, including additional around 3.5 billion of brokered premium. The also interesting thing for us that we are seeing more diversification in the nature of risk covered by firms in the DIFC. So if you look at the same pie a few years ago, fire and property was a big chunk, but now we can see more and more risk covered by firms in the DIFC. And the other interesting part for us that we are seeing some new risk coming, including cybersecurity and other specific or specialized risk covered by firms in the DIFC. So just a few players who are represented in our market. So that tells you that we have players from the insurance sector, from the insurance industry, coming from all sides of the world, operating and using the DIFC as their hub for doing insurance business in the region. Coming to our regulatory agenda, so just focusing on those impacting the insurance business, because the regulatory agenda is a bit much bigger, particularly in areas related to innovation, crypto, tokenization, and so on. But focusing on those mainly impacting the reinsurance business, last couple of years we've done a lot of work to revisit our regulatory regime to make sure that we continue to be risk-based and to basically ensure that all our regulations are there for a purpose. So our aim is to avoid any unnecessary regulatory burdens and facilitate the business environment for our firms. So we revisited our prudential requirements, particularly for captive insurance, but also for insurance intermediaries and insurance managers to ensure, as I mentioned, these are really risk-based. We recently also introduced changes to our regime related to authorized individual, and that doesn't impact only the insurance firms, but also across the board. But that is part of our aim to strengthen governance and accountability of senior people in the financial service industry. Currently on our plate, two key regulatory initiative that we're looking at. One, operational resilience framework, which is, again, that applies to everyone, but this is very important in light of all the risks that we were discussing this morning. So the first phase of that regime will be coming out for consultation at the end of this month's relation to the identification and evaluation of critical business services, and then few phases will be coming after that, particularly in relation to reliance on third-party providers and also cyber security. The other piece, which is not mentioned on the screen, last year the UAE has updated the federal law in relation to financial crime. I think also Mark this morning mentioned the importance of financial crime for us. That will be mirrored in our regime very soon, and particularly why I'm mentioning this, because that's aligning the financial crime framework with the FATF recommendation, and basically when it comes to insurance business, that will reduce the existing regulatory burden for most of the insurance firms, particularly those which are non-life or non-investment insurance. Finally, from a supervision perspective, on the agenda for the next 12 to 18 months, two key themes for us. One is data. I think everyone agrees the importance of data. Data is becoming much more complex, but also ourselves as a regulator, we're more and more focusing on data, and we're doing what we call the data-led regulation and supervision. So we will be relooking at the data requirement for particularly our insurance the insurance industry in the DIFC, to refine it, make sure that we have all the data that we need, and to enhance the accuracy of the data that we have. The other area from a supervisory perspective, we will be focusing on conduct of business for insurance intermediations, issues like premium pricing, grossing, transparency, and so on, to make sure also that the integrity of the insurance market in the DIFC is based on strong foundations. Sorry, I've had to be running very fast, but I hope I gave you a little bit of flavor about the insurance business in the DIFC, and thank you very much again for listening.
Thank you very much, Mr. Mohammed. Thank you. I was told that we don't have enough time to ask more questions, and we will have like 10 minutes break. Yes. 10 minutes coffee break. Okay, thank you. Thank you very much.
Thank you, Mr. Ala. 10 minutes coffee break. Let's have a brief coffee break and come to our sessions because we are behind times. I'd like to remind you of our invitation for tonight's gala dinner in this room and around this area. We are starting at 8 o'clock and there will be some local show, musical show. Thank you. Looking forward to you.
Actually implementing what you'll hear about today in terms of the future of insurance, using data, using AI, using machine learning in reality for insurance companies to do things in a different way, in a futuristic way, in a better way, in a more risk-averse way. And probably one of the reasons why I'm hitting the two hats is because although I am a qualified actuary, I'm also a software engineer by background, and I only became an actuary by mistake. So that's why I probably spend more time towards the data and AI than I do towards traditional reserving pricing that you associate with actually.
Thank you very much. So before we start this session, I wanted to share some data points just to set the tone. And the data points is coming from, I would say, the macro level to begin with. And it's a global executive survey conducted by the IBM Institute for Business Value. They published a report recently called Insurance in the AI Era, Embracing Innovation, Fostering Responsible AI, and Delivering Exceptional Customer Value. And secondly, lately at some investor level, I know a group of private equity folks who visited the Bay Area recently in January, and they did publish their insight after they met multi-trillion-dollar market cap companies, new vanguards, and some academics. So the survey, in terms of highlights, the focus today in AI has been primarily to optimize processes and enhance efficiency. At the same time, it's acknowledged that technology is now in shape to reshape how insurance operates, namely unlocking opportunities to redefine the customer expectation, operational agility, and how insurers modernize their business. At the same time, insurers must also address the technical gap, the skills gap, the regulatory compliance, and the imperative to align AI adoption with customer needs and expectations. From the investor, with their forward-looking view, they're looking at the insurance industry, as we say, is going through some sort of metamorphosis. For instance, remember, it's not that long ago that a chatbot would help you filing a claim. Now we have agents that basically can do claim settlement, payment, when you're practically just filing the paper. Having said that, the insurance industry is in a really good position to move from the chatbot to the agent, because the core of the product is based on risk data and financial execution. So the modern agentic agentic stack, the insurer would have all of this stacked together. These days would have what we'd call the brain, meaning having at the big picture level, having the ChatGPT and the Gemini for underwriting, and underwriting reasoning in the sense that being able to evaluate complex medical history, the commercial property, satellite imagery, with reasons behind. For instance, is this building risk fire mitigated by the new local infrastructure? Then the second layer, so those are the LLMs, this specialized small language models could be handling more precise and high precision execution. For instance, let's say the Vision SLM could analyze car accident pretty accurately to know if it's a total loss or just like a dent on the car. From the fraud SLM, cross-referencing thousands and thousands of claims in like milliseconds to find the fingerprints or organized fraud rings will be doable, because we know that fraud is a big risk for insurance. And finally, in the middle, you need to have all those agents to interact together. So how do you orchestrate all of that? For instance, you could have one that could trigger a drone to come to do a core roof inspection. Then you could call an API where to check the weather and the weather record during a storm, and finally, all of that being triggering a payment without the involvement of any adjuster looking at the file. So that's for the insurers. So now what are we looking at? It's more moving from productivity to authority. And productivity, if you look at the software would help underwriter to do one thing. Now with AI, what we're going to be able is not to do one thing, but it's to automate some clear submission and solution. So even the pricing of that technology will change. And then for the insurer, they're going to be moving from detect and repair to predict and prevent. So for instance, the agentic risk, as opposed to wait for a pipe to burst and then pay, they could detect if there is, let's say, a leak, and then call immediately somebody to come and fix it before a full claim happens. So the insurer will have to be comfortable in giving authority to the agent in order to process with the claim, and the insurance will be more of a state of your business as opposed to wait for something to happen. So having said all of that, I'm going to ask my panelists questions related to the insurance sector. So, for instance, Dave, working at an insurance company, what aspect of the insurance business model do you expect the AI to change the most, and why?
That's a big question. And I think maybe a good step back is to think about what is the insurance business model, because many times we get a little focused, particularly as actuaries, in different pieces of the model. But when you take the step back, first it's good to ground that fundamentally we are an organization that is out there to serve people or businesses. So it is a service-oriented business model. And so I do think that is going to be one of the areas that obviously we're going to see a lot of innovation in the way that customers are served by insurance. I'll come back to that in a minute. Another thing that's very interesting about our business model is that it is heavily data-centric. Right? In many ways, the products that we sell exist as data, exist as information about this policy was sold to this consumer, and that this is the coverage that is there, and it exists in our computer systems, and it exists as data. So we are a very much data-centric business, and we are a very much a service-oriented business. So I think that does mean that there will be many things that will change as AI enables data to be acted on in a different way. So again, I just see that going to be something that touches just about every aspect of our business in some way, shape, or form, as more and more people are able to interact with AI and interact with our business through AI. But I do think fundamentally the biggest change will be in the service side of our business. And that's where you'll see, again, much more innovation. I think it's interesting when you see a lot of the commentary that's happening somewhat inside the industry, somewhat in other industries. People are touting a lot of the opportunities to get more efficient, to take people out of the loop and the costs of people out of the loop. But I actually think that's the wrong way for our industry to focus. Certainly it's the wrong way for my company to focus. What we really want to do is focus on how do we improve the member's experience in interacting with us at the point of claim, at the point of sale, at the point of recognizing I have a life event that should change my insurance needs. How is that simpler? And how do we support a human-to-human interaction from a well-supported agent or person agent who is supported with technology and artificial intelligence to make that interaction with the end consumer all that more clear, understandable, precise, timely, and really much more service-oriented. So I believe that companies that take that approach to using AI to innovate their service orientation are going to really unlock a lot of opportunity for themselves and serve their customers better.
Thank you very much. Now, Davide, you interact with many companies. So how do companies that serve the insurance industry keep up with the pace of AI adoption today?
No, it's a good point because we are a service company, right? So we are a technological company that provides software solutions to carriers. So be that spent the last 12 years in risk-carrying entities, and the adoption of AI, machine learning first, AI now, it follows a completely different path. In a technological company, the story is completely different because we don't have a lot of customer-facing activities. So our customers are some of the people in the room as well, right? So carriers, NGAs, and actuaries that work in those companies. So the adoption of AI in this front-end side of the business, I don't see that happening. We are really B2B, so it's very much relationship-driven. We also have a lot of customer support so that people make use of the software at the best, in the best possible way. We have humans that do that, and we don't see any adoption of generative AI on that side of things. That said, it's also driven by the fact that the number of interactions that we have in B2B is manageable by humans. So our customer support, technical roles are measured in the dozens, right? And we can keep up with the volume. So that's for the front end, I would say. When you start to look at how, for instance, the engine of our software works or the backend and the internal operation, that's where we instead, we just took a big leap forward in just, if I look at the last 12 months. So, for instance, in the backend, everything that has to do with software engineering, code development, CRM, sales ops. So we use massively generative AI there, and it just makes our life so much easier. And we can, look, if you look at my role, for instance, I'm in sales, right? Say I have 500 opportunities in the CRM. I've worked for the company for 6 months. There's no way I could get a handle of all of those opportunities if I didn't have an agent. And we do have now self-developed agents in the company that help me get the most important information that 2 years ago I would have had to look up manually or ask someone in sales operation to help me out understanding who's who, what's the state of the contract, what's the state of... All of this information can be now very easily summarized by agents. And our colleagues in software development, they use that day in and day out. So there's a massive adoption of Gen AI in the company for that. The third area is how the engine, the calculation engine works. We're not a data-driven company per se. We don't have access to the data. We process through algebra, company's data, carriers data. We've always had machine learning at the core of the solution, but that has nothing to do with Gen AI. That's changing now, especially for the US. We just did an acquisition that is specifically targeting Gen AI cases in US filings. And that's super powerful. It's just amazing. If you look at what you can do today compared to what you were able to do 12 months ago in this space, it's just mind-blowing. But that's something that is specific to the US market because of the way filings work. Yeah.
And Assad, how about you? What would be the area of changes where AI can have the biggest impact, and some example of that?
So, look, before I answer that question, I'll just take a step back and kind of see AI is a very loosely used term. And although since the inception of ChatGPT's prominence, it's slightly more understandable for the common folk, people still don't necessarily understand what AI actually is. And so they're thinking ChatGPT is AI, but effectively that's not the case. ChatGPT is just a software that's being built upon AI. So I think that the issue that I see with all of these things, with what Davide also mentioned, is, insurance companies, the AI that you're building in, whether it's in the pricing or anything else for that matter, is only as good as the data that's going into the system. And unfortunately, for the last so many years, we have created biases via rating factors in our systems. And so the AI is only going to accentuate those biases if we don't do something which is fundamentally new and different. And this is where, the Middle East has an option of kind of thinking about how can we do something different and not make the same mistakes of those biases. For example, right now our rating factor says anyone below 25 is a bad driver, full stop. Anyone who's a female, for example, or a male or whatever, has a certain way of driving in our modeling. So regardless of what we do with generative AI or anything else for that matter, we are effectively feeding that information and getting that to tell us we are right. And this is where we need to think fundamentally of how do we apply AI, not just ChatGPT or some of the machine learning algorithms, to fundamentally change the experience of how do we do business. When it comes to insurance, motor insurance, let's take an example. The color of the car, the size of the car, the engine size, those are not going out there and causing accidents. It's the driver behind the wheel who's causing the accident. You could be the best driver in a Ferrari and a worst driver in a Toyota Corolla, for example. But when we are rating it, we're basically not giving that preference. And unfortunately, our data also does not give that preference. Unless we get better ways of getting data. So you mentioned something about gas leaks, etc. But you need to be able to get that data before you can actually generate that information. And unfortunately, the market here in particular, and more broadly, you need a fundamental shift in how do you actually capture that data. Because for you to be able to service, both from an underwriting perspective as well as claims perspective, you need to know your customer, you need to understand that data. Only then can you use the data. Unfortunately, everyone is talking about how do you service customers without talking about how do you fundamentally get the data which will help you service the customer. And I'll give you one small example, as I said, because I think it's always, I hope I don't, make anyone feel bad, because I'm not going to take the name of the company this time. I did take it in a conference previously and the underwriter came to me. But in UAE, 2019, there were floods in January. I remember we were at Milliman conference in the US. I came back, I had a car and my car's insurance had expired within that 1 week while I was in the US. And that was the week when floods also happened. And the chief underwriting officer for that company has been sitting with me for the last 2 years on these panels talking about AI and machine learning and how InsurTech will change, what they're doing. So I called him and I said, I want my insurance to be renewed. He said, sorry, you'll have to take your car to a workshop. Now I'm very busy, I was traveling. I said, I can't take my car to the workshop. Can I actually take a picture, send it to you, or can I give you in writing that there's been no damage to my car while I was away, because I don't have the time to take my car to the workshop. He said, no, we can't do that. Our process is you need to take the car to a workshop. And thankfully, I knew a lot of the CEOs and underwriters, so I called another company, and even then they took the pictures from me with a date stamp and then gave me an insurance policy. And the original company lost my business. Thankfully, since then until now, I've not had an accident. So I'm a customer who's driving less. I have multiple cars, and therefore I'm a customer you want to keep as an insurance company. But you lost out because of your stringent policies and not thinking about how to apply technology. So coming back to our conversation, had they, you talk about visual SLM, but you need to have an application or something to be applying the visual SLM to. But if you don't have those processes, you can't do anything. So what we don't talk about is how do we actually capture that information to make the customer experience better. I hope I've answered that. I just wanted to give that example because that's very important.
said, I think it's a very powerful example because what it's showing is the need for organizations to actually identify the processes that need to change and then actually have a plan to change, to use the technology from data collection all the way through implementation. And I think that's something that sometimes we as actuaries, since we're focused on our piece of the puzzle, we sometimes miss that that's what has to happen in the entire space. There has to be a plan to actually bring this technology to life. One of the things I've often thought about also is in this advent of AI is that ChatGPT, I like what you were saying, it's more kind of an interface into AI. And it's made it so that everybody can interact with AI. It used to be that you had to be a highly technical person to be able to touch an AI model or be able to do something. Now everybody's interacting with it. But as I think we've all seen when we put queries or questions into ChatGPT, it gets good information, and it's kind of mediocre, right? So I think what that means is we've got mediocre models for everyone. But to actually do really good models that actually change my business and actually improve customer experience are actually going to be what I want to build my business on, that's not only going to be a mediocre model. We have to figure out how to get the good models that are actually fit to the right data, impacting the right processes in order to make that happen.
But just on that very important point is, ChatGPT gets a lot of things wrong a lot of the times because it's how you ask the question. But you can afford to have that wrong because we are using it for research purposes or for our own purposes in terms of it's fascinating to get some answers rather than we're using it for business, for example. But when it comes to actually using it for customer service or chatbots, etc., you can't afford to give wrong answers. Because once you do it once and the confidence level goes away, people will no longer want to talk to chatbots. So that's why what you'll see right now is a lot of the people, when you go and talk to a chatbot, they will ask the first question, are you a chat or a bot or a human? And it's because they want to talk to humans because they're not confident enough because they know they can still get it wrong.
Yes, but at the same time, also humans make errors, right? So I think we need to get automated systems to have the same error rate of humans or better. So be it on automated drive, be it in servicing the customers. And the moment we get there, and I'm with you, right? This is not AI per se. It's a system that automates very efficiently algebra, mathematics, software engineering, and it's trained on text. It doesn't have a word model that's going to come with the next generation of AI systems, JPAS or whatnot. It's not there. We're not going to get there, I think, with the current system, but still it can be really useful, right? Where algebra is, or math or software development is included, like already today, there's massive improvements in terms of ability to serve your business needs.
But I'll tell you something, and apologies for taking long this. This just happened yesterday, which I found very fascinating and change and shift from ChatGPT or Gemini or whatever. Previously, it used to accept its mistake. Now somehow it's justifying it. So it's becoming a human. And that's the problem. And this is like yesterday, I got into a lot of crypto, so I'm following that quite a bit. And obviously the market has needed quite a lot in the last couple of weeks. So I asked for, what is the current price, just to see what was happening, to see what the answer would be. And it said, oh, the price has gone down to 60,000. I was shocked because I had bought it at 100 or something. So an actual price was 75. So I then said, no, you're wrong. It's not 60. Can you check it again? And rather than saying, sorry, we are wrong, it said, sorry, I gave you the wrong number because I thought you were asking for the expectation because someone else said that it might be 60 today. So it started justifying its response as opposed to accepting that it was wrong. So we are getting ChatGPT as a human now.
All right, so we got some interesting feature in stories from the insurance side. Now, I'm going to ask something on the actual side, and I want to leave like 10, 15 minutes for you to ask questions, because as you can tell, we have an interesting conversation, an animated conversation going on. So with respect to the actual profession, by training, actuaries are in a good position to tackle the challenges faced by the insurance industry in the venue of AI. Today, the investment has been mostly done from an operational perspective, but clearly, on the other hand, actuaries are playing with it from a financial reporting, assumption settings, and the like. So having from operation to risk management, if I may say, Dave, how can actual skill set be leveraged as AI applications become more embedded in our businesses?
Thank you. And again, I'll speak a little bit more from my hat bearing for the Casualty Actuarial Society, where our members already are very well embedded in many places with regards to analytical models, predictive modeling, really understanding how to take data and apply it to many different applications. Within my organization at my company, I have teams that are focused on the traditional actuarial roles that, of course, are pricing and reserving and catastrophe modeling, those sorts of things. But I also have people that are data scientists that are involved in those things. And I have actuaries that are involved in claims process, claims optimization, operational modeling. I have actuaries that are involved in our distribution channel that are doing that same sort of thing. So I see how the actuarial skill set, particularly the skill set we develop and foster at the CAS, is actually being able to be applied across the P&C, the property casualty or general insurance value stream. And that, I think, is really powerful. And what I think we have succeeded in doing at the CAS is helping our actuaries really understand the full system of the business that they are in, and really asking, how can data and analytics help me understand, yes, the risk that's involved, yes, predict the loss, but how can I understand the system that is generating the loss, generating the exposures, and how do we change that? And so I think that becomes the strength and the skill set we can continue to leverage. Now, I think the other really important thing that actuaries have a long history of is that we also need to recognize like the market realities, the regulatory concerns, the things that need to be in place in order for us to have confidence in the models. And that is something we've been doing for decades, really, is helping us build models, put them into use, build confidence, both internally and with regulators and with consumer points of view. And so that is going to be even more important for us to do within the generative AI and the further AI enhancements world. So our ability to understand the technical, understand the system, and understand the multiple stakeholders and points of view and help to build confidence across those stakeholders. Those are the skill sets that I think we're going to continue to be pulling on again and again. And as I think Paul Sweeting said in one of his introductory comments here, why he believes, and I do too, that the actuarial career field can actually grow as this technological change continues to build speed, but it will only grow if we continue to leverage those three types of skills and put them to use, not just in our traditional areas of actuarial application, but help our companies in the other areas where AI is going to transform as well.
Thank you so much. Now, Davide, from a European actuarial landscape, adapting AI in insurance, and also what type of actuaries are good candidates for a tech company?
It's a very good question. So the actuaries that we have in the company, again, you measure in dozens, right? Because more than half of the company is engineers, DevOps, software engineering, hardcore coders. Actuaries that join Accurate, they definitely need to be open to using AI and being able to make the most of the few resources that we have. One of the things that I think, as of today, we really jumped to the deep end of the pool in the company is that pretty much every core function of the company, be it in sales, sales ops, be it in engineering, be it in actuarial data science, be it in marketing, you need to have the ability to build your own AI agent to make your job easier, faster. So if you're in marketing, you have to be able to do marketing at scale. You have 6 or 7 colleagues, right? And you need to be able to deliver at a scale like if you were a team of 40 or 50. So every core function has an AI champion that will vet the agents that you as an individual need to build. Now, as we were saying, things have become, natural language. So it's much easier to build an agent today, provided that you give it the right access to company data, your own data, and the results that you get are just going to be as good as the data that you feed it. The clearer you make a prompt, the better the result is going to be. So we don't put it yet in the in the job description, just to go back to your original question, but you really need to have an open mindset and an ability to learn fast how to interact with your favorite LLM, be it Claude, be it OpenAI, be it Gemini, and you need to be able to have that mindset. Otherwise, in companies that need to deliver at scale, you can't keep up. You can't just sit down and do things the old way and just scroll through the CRM system manually. You're not going to be able to deliver.
Yes, and I'm looking at Assad, and I think I know the answer already since he went from engineer to actuary to engineer to actuary. So if there were something to change or to add to the actual exam concerning this AI boom and how can actuaries work in this space, do you have some example? What would be your view?
Look, and again, I'll try to be quick because I know we're running out of time, but I think the important thing is if I talk about actuary first, when I was at KPMG previously and then when I joined Milliman, one thing that we were already encouraging everyone in our teams to do was to run random forests or other types of LLMs, or at that time they were called predictive analytics, different types of things, right? So we were already doing that. So for me, some of that skill set was already there within the actuaries, and it was a natural extension into what we're doing. So yes, you can use what's already out there, but you can also build your own internal engines as well to kind of see, okay, what kind of results are you getting to validate what's out there, even using your own data. So actuaries do have that skill set, especially when it comes to pricing actuaries. They started with GLM, then they went into other types of more predictive analytics, which is already happening. So from that aspect, there is quite a lot of synergies between what generative AI developers are doing and what actuaries can do in terms of skill set. What is missing, which is where your question comes to, is can we add additional types of development for these actuarial students to kind of think about it from a more logical, technical perspective? And I think from there, maybe some sort of a software development within the actuarial part, not too much, but maybe one module here or there might be very useful. From my own experience, coming from a software background, getting into actually, I felt that it actually gave me a much bigger edge than I thought when I was growing up and writing these exams, just because the thought process that you have with that skill set from the software engineering side is very different. So actuaries tend to look into a tunnel, and software engineers sometimes can look at the bigger tunnel. So if you combine the two together, you actually get a much better solution in the long run.
That's great. If I could tag onto that too. So for everyone's awareness, within the Casualty Actuarial Society, we now have added an element to our curriculum, our exam process that we call our PCPA, our Property Casualty Predictive Analytics requirement. And that is actually a step in that direction where we actually, it's not just an exam, it's a little bit exam, but it's actually mostly a project where you're actually coding, you're actually building models, and hopefully better than mediocre models. And you're actually getting feedback about how are you doing and actually getting your hands on the keyboard and working with that. That's the one place where we are also now looking for how do we then incorporate experience interacting with AI tools through that platform as well. So we're excited about that now being part of the process to become an associate of the CAS.
And just finally on that, I think the example that I talked about was what we did do as the actual company was, when we talk about understanding the customer using AI, we actually built an in-house AI where to encourage customers doing certain behaviors, rather than applying a one thing fits all, we built an AI where you put in the information about, okay, this is a French citizen, 50-year-old, or a US citizen, 60-year-old male, or a Danish citizen, 40-year-old or whatever. And it will use all the characteristics of those particular nationalities, age groups, etc., that's available to then tell you what type of incentives or gamification could help encourage their behavior. So it's those kind of things. Again, what you're doing is you're taking data to customize the experience for the customer, but that can only happen if you, as an actuary, because you understand the risk profile, and as the generative AI, you know the details that the actuaries don't normally capture, which is how does a Danish like to play their games versus the French, for example. So this is where the collaboration between your actual mindset and some of the information that's available through these generative AI models could be very useful, and that's what we're working towards.
All right, we have 5 minutes left, so it's either we allow 2 questions, ask for an extra 5 minutes, and we get the final views from our panelists. So anybody would like to ask a question?
Consulting, and I have something common with Ashit that I am an actuary with a CS background. So my question was primarily on a point that Ashit raised, which was a very good point, that a challenge that we all face is that we want to do a lot of innovative things with AI, but we get stuck at the first hurdle is how do we get the data that we can actually use to build this thing? And we're all stuck in this sort of a chicken and egg problem, right? Because we have some data, it has biases, it has its problems, we want to get better data, but there are hurdles. So is there a recommendation that you could have on how do we actually get the data? Because like you said, this is a conversation we're not having. So let's have the conversation now, and I'd like to hear your thoughts on it.
So very good question. And I think, look, for different lines of business, there's different ways of getting data. But let's take motor as an example, then we can move to health. But on motor, what we have done and what we've been advocating for the last 5-6 years is the advent of telematics. So the idea there is that, you get live data immediately. And so you go away from the biases within, like for example, we have almost 30 billion kilometers worth of data within Milliman. And that was, within a year or so. So there's a lot of data that you can gather, and especially with the connected cars, getting data is easier, much more now than it was in the past. So getting that data either via smartphones, devices, or the cars themselves helps us get that data, which we can then train towards the actual reasons for accidents. And one, again, the example here is when we looked at the actual reasons for accidents in Saudi and UAE and other parts, it was lane swerving, going off the red camera, speeding was the least reason why there was an accident. But when we look at our data, speeding, even although our data doesn't capture it, we think speeding is the biggest reason. The biggest reason is actually cornering and braking. The biggest reason is use of smartphone while driving right now. It's those things which we cannot capture right now. And that's why we've been pushing for that. The same thing goes with health, with Vitality and other products that are out there. Getting information about how do you live your life. Imagine if you're a bank. When you go to a bank, they look at all your history and then they tell you, I can give you a loan or not based on what you earn. Not because you're a 25-year-old, so every 25-year-old should get a loan. This is where we are lacking as insurers. And this is why, unless we think about the options of getting the data, we can never train the model.
And I think if I could add to that too, sharing a little bit about what I've seen within my company. One of the really positive things about the buzz around AI is it's actually gotten other business leaders, not just actuaries, not just analytical or IT folks, to really think about the value of data and the need for data. So I found that my peers within my organization, all reporting to our company president, my peers are now demanding more from data from my team that helps us design and develop the data assets. But they're demanding more than they ever have before, because they're starting to realize that if we're going to actually do what AI has the promise of doing, we're going to need to invest in data more. So maybe that's not quite happening in your companies yet, but it is something that I would say definitely use the momentum around AI to help everybody become a data advocate. And it's happening. I'd say it's happening in many companies today. And so encourage the leadership within your company to understand that value and to invest in it. And then once you do that, it doesn't take very long for an AI model to use data that is being collected. So you can actually pretty quickly turn investment into data into value if it's designed well and if you're ready to implement as soon as you build those models.
All right. So having said that, I would ask to start with Davide about any provocative thought or future development you'd like to share with us.
Yeah. Just by show of hands, how many in the room have heard about OpenClaw? 1, 2, 3. Let's say 10 people. So this is AI going off the rails. It's basically you take your best LLMs and you take any guardrail off. Super dangerous stuff, super fascinating. And that drives me automatically to think, if you had that sort of approach to AI, when do we see the first company that transacts maybe more than, 100 million US dollars with 4 people. Let's say an insurance company with 4 people using this technology, is it feasible within the next 3 years?
As long as you keep the actuary, I don't know who are the remaining 3.
One is going to be in the actuarial department, sure.
Okay, how about you, Assad?
Ask for a show of hands. How many of you in the audience have children below the age of 12? Almost 30%. Have you, do you expect your children to buy insurance the way you purchase it today? And I think that's the future of insurance. I think the problem is that we need to really think about the upcoming generation. In my, I have a 12-year-old and a 9-year-old, and everything they do is on their iPads. Even schools require an iPad, and they are much faster at ChatGPT doing their homework than we could ever think they could. And sometimes it's shocking how quick they're learning all of these things. And they will not be using brokers. They will not be calling people to get insurance. They would expect insurance to be on their iPad as an icon where they click a button, get everything done, and similarly for claims and everything, because they're living in a world, they've started in a world where there is no other ecosystem than the digital ecosystem. The world lies on their fingerprints on their iPad. And that's what we need to do, is the future of insurance has to look into that. Whether that's through customer service, whether that's through understanding the risk, capturing the data, or as you said, doing things in a faster, more efficient way. But it has to change from what currently looks like. And until that happens, although we are okay for now, for the next 5-10 years, the next generation is not going to understand insurance the way we do it today.
Right, how about you, Dave? 1 minute.
1 minute. Okay, so 1 minute. What I would say is to the actuaries here that we're meeting with today, we have a unique opportunity to really harness the power of AI and make it happen within our companies. And I believe that we are uniquely positioned as a profession to do that well, to do it in a way that is highly applied, that is actually changing our business, and is trusted and is confident, and that people trust us with the way that these things are implemented. So my challenge to all of you is to embrace this. If you haven't yet really gotten into a place where your company is engaging with AI, look for those opportunities, be part of it, learn what you need to learn to become a master of AI, and really help this come forward in your organizations as soon as you can.
All right, thank you very much, and thank you for your attention. Thanks to the panel.
I was not supposed to be moderating this session, but I enjoy moderating sessions. So Ian could not come to the event. Ian is the president-elect of the Society of Actuaries in US, so I was so lucky to take his seat. Universal health. Is this a buzzword? Because in the last 10 years, we've heard universal access to finance, universal access to telecoms, universal access to education, universal access to everything. Governments historically have been in charge of providing health services, constitutional rights, healthcare, everything. For the last at least 200 or 300 years, government have been shouldering that responsibility. What is the new push? What is the new shift? Why are we hearing about universal access to health? What's the big buzz about it? How is it different from the healthcare structures we've seen, we've experienced ourselves since our childhood? The good thing is, I have 2 great catches. I have the principal of Milliman, probably the largest consultant on health and risk advisory in the world, but also in the region. Safdar has been leading this practice in the entire Middle East. He's the principal actuary and managing director of Milliman for Middle East. And on my right, I have the CEO of a very look, okay, please give me kursi. I have been looking for you, sorry. Allah يسلمك حياك. Yes, And on my right, I have Ms. May Farid, who, by the way, is also a Vice Minister of Finance. She worked with Dr. Ma'id when he was Minister of Finance, and is still till today, she is a Vice Minister of Finance, very much involved in the social protections and economic equity side of things. But for the last 4 or 5 years, she's been heading a very ambitious project in Egypt, directly associated with the presidency of Egypt and the government, and it's called the Universal Healthcare Authority in Egypt. So we will use SEFDER's think tank power, because they are the people doing the analysis and the insight, and we will get insights from Mrs. May, because she has experience on the ground in the largest Arab market for healthcare. I mean, if any country is suffering with pensions, with healthcare and everything, the more typical, the more chronic case would be Egypt. And we are blessed to have her in this session. And we also have Dr. Ramzi Abu Jamra, a Lebanese American, and he's also a healthcare actuary. So to warm up, as a warm up to this, before we start their slide, I would like to ask Safdar on the thinking and the planning side. What's the buzz about universal access to healthcare? I mean, government have always been in charge and leading and the guarantor and the administrator of healthcare. What is universal access to healthcare is all about?
Sure, that's fine. So I think, as mentioned, universal healthcare is what we refer to as a buzzword. The reality is every individual must have access to good quality healthcare. And when you mean good quality healthcare, you ensure that both the means of getting the healthcare is there, but also the quality of the healthcare is provided, where patient centricity and the patient safety is taken into consideration. I have been working in this market for the past 20 years on the health side in the GCC, and we have seen significant development where compulsory mandatory healthcare commenced in Abu Dhabi, where you have the basic cover, the TICA cover, and the ABM, which is the activity of the different components that come in over and above the mandatory healthcare. They started the journey in the 80s, and they have significantly moved from where they were to where they are, not only in ensuring that the entire population is covered, but also the modes of payments from the payer to the provider are changing significantly. Thereafter, you have seen developments in the rest of the GCC. Look at Dubai, to the Dubai Health Authority. They have been transforming healthcare as well. We can talk about the details later. The Kingdom of Saudi Arabia, huge population, both expatriate as well as the local population. Massive transformation. It all started from the private sector to the cooperative health insurance, where the essential benefit package was established. And now it's moving towards reimbursement, moving from a fee-for-service environment, we'll talk about that later, to a more capitated approach.
Thank you. I think we'll keep it here. Dr. Ramzi, you are a healthcare expert, and an actuary. You have done your own sort of theory or look or vision into it. What's universal healthcare is all about? Maybe in 2 minutes maximum.
Ibrahim. Thank you, Ibrahim. Appreciate the introduction. And I think what Ibrahim was saying was, I try to think of innovative ways in healthcare. As far as your question, you know what comes to mind, and I came from the US, so my perspective is generally going to be representing the US. The biggest thing happening in the US that I see now that is very fascinating is what they call transparency. Transparency is a movement that is challenging health insurance because the consumer is unhappy, and the consumer and the doctor are feeling the pain, and they are realizing that through transparency, they can go around insurance and get what they need. that is the story that I see hugely predominant in the U.S. And growing. And what's nobody knows where it's going, really. You may have heard of Mark Cuban, some of you, and essentially that's what his whole movement is. But if you think about it, that is really embodies the whole idea of how are we going to finance health insurance and healthcare to our nation. And so you go from, are we going to be insured, or are we going to be totally consumer transparency run, like it's moving? But the reality is it's going to be a mix, and it's going to take innovation to fully realize how we are going to create the strategy for that. I certainly have ideas with a lot of the work I've been doing, Ibrahim.
Thank you.
Yeah.
الأخت May, you have seen it all. You have seen the typical historic healthcare structure, healthcare system, and all the constitutional services, social services that have been rendered to the public, to the Egyptian citizens. And you have seen the rebirth of the health promise again through the universal healthcare authority structure. What's the difference on the ground to the Egyptian citizen in a nutshell?
Yeah, sorry. Thank you, Ibrahim. Well, the big difference between the old system and the new system, and because we used to have health insurance since the 60s in Egypt, is the fragmentation, basically. So we used to have a very fragmented system with many health providers and intersection between and complexity in the payment system between the payer and the providers. And currently, what we did mainly in the new system is the separation of functions between the payer and the provider and the management and the accreditation and supervision. This helped a lot in the reform.
Thank you so much. Maybe we can start with your presentation, but try to make it quick so that we...
I'll make sure that I will finish it very quickly, but I don't have the... I have to be there? Okay, yeah. The public health expenditure is about 4.7 and 30% out of the current health expenditure, while out-of-pocket is still high of 60% from the current health expenditure. This is very quickly that we are committed to the SDGs goals, and that the new law that has been launched into 2018 has been done to go with in line with SDG targets. And then let's go to what I was just mentioning, going from a very fragmented coverage to a comprehensive coverage. So what we had before, or let me go through very quickly the features of the old one through this diagram. This is the complexity of what we used to have in the old system. So if you can see, we are having many health providers and many entities that are already paying for them with a very complex system that you don't know who is receiving, who are the beneficiaries, if they are receiving or having access to health services with equity, with good service or not. It's very complex. You can see that from the structure, whether from the revenue side or from the purchasing side or even from the providers. What we move to this is the new system. So what we have now, that we have done some sort of consolidation or fund pooling for the services. Now we are having definitely the revenues coming from the general government revenues, from the contributions, from the EU market taxes, and I will go through this in details in a while. And we had this all under one pool, which is UHIA, the Universal Health Insurance Authority, which is managing the funds. And still we are having the Ministry of Health and Population just for the preventive and public health services, with other two entities like Ministry, of course, of Higher Education for the university hospitals and stuff like that.
and the private insurance. Of course, it's coming for the complementary and supplementary. So if you can see, we tried to remove all the complexity and the intersection in between different programs and to make it more structured, having the service provided from all the providers, whether they are public or private, and all of this with common factors that we are having a unified procurement authority that can provide them with all the supplies and medicines. Okay, so if I go back to the new structure, what we have done that we used to have what we used to have was and we used to have an opting out for in the old system. Now it's a mandatory system. It's based on social solidarity. The family unit is the main, and we have the gatekeeper process, like in having to, you have to be indicated to a certain family doctor, and then you will have to go to the referral. The new system is going into a more of a geographical implementation, so we are rolling out one governed rate by another. And of course, as I've mentioned, the separation of functions, and it has a very comprehensive benefit package. This is in a nutshell the new features of the new system. So again, to do this, we had structured three main organizations. The first one, UHIA, which I am honored to represent. We are managing and financing the pools, as I've said, and you can consider us like the biggest health insurance company in the country, more or less, because we are, by the end, having a strategic purchasing mechanism to purchase the service from any accredited provider. We are having EHA, the Egyptian Health Authority, under which we consolidated all of the fragmented public facilities that are providing service under one body, which is called EHA. And Gahar is responsible for the accreditation and the supervision on the quality of services and the regulations. And it's a prerequisite that the facilities that will enter my network should be accredited first from Gahar, and then I can contract them to be part of my network to assure the minimum level of quality provided. So again, I will not go through this. It's a very complex and it needs some time, but this is some sort of like the ecosystem currently in Egypt. What are all the entities and their interrelationships, whether as payer, as a provider, as the Egyptian citizen, the Ministry of Finance, its role, and as well as all the other authorities that are affecting the health system in Egypt, the Egyptian Drug Authority or else. And as an overview on where we stand now, we started the implementation in 2018. It was split into 6 phases. Currently, we finished the first phase of 6 governed rates, about 5.2 million beneficiaries, enrollment of around 82%, and our network currently we are contracting more than 526 providers, out of which 32% is from the private sector. And this is considered a good percentage, since the governed rates that we already entered in phase one are not that much engaged or have a big engagement from the private sector. Yeah. If you can see, we had a bit of more time in phase one, but this was pretty normal and expected from our side, first because we were hit by the COVID, and also because of the all the challenges and the change of the whole structure, the management structure. Even it was very hard for the employees themselves. So it took us a lot of time to make sure that we have all the lessons learned. We know all the challenges, how to overcome now in the rolling out. We are having our IT systems in place, databases, everything. Currently, we are already moving in phase 2 with a very smoother and expected to be accelerated process of rolling out. Okay, the actuarial study, Dr. Mait in the morning, he mentioned that it's stated in the law that it should be revised every 4 years, and that's what we are doing. Actually, we started in 2018. Before 2018, we already had our actuarial analysis on the financial sustainability. We ran more than, maybe as far as I remember, there were more than 90 scenarios till we reached the scenario that's more sustainable to go on the rolling out. After 4 years in 2022, we had another checkpoint, and currently in 2026, we are about to have another financial assessment to see how it's going on the financial sustainability of the system and to in the future, yani, until we finish the whole rolling out. Basically, I will not go through this because yani in the house of actuaries here. So I think that everyone know what are the assumptions that we should go through in any kind of such assessments, whether they are on the expenditure or on the revenue side. I just want to go through the structure, the financial structure of the design itself, how we structure it. So what we did.
1 or 2 minutes maximum.
Maximum. I already covered this.
Except.
So what I'll say, yes, the revenue or the more important parameters that we try to cover, that we are having the financial structure of the new system under 3 main components. One coming from the EU market taxes, and this is what's distinguished the new universal health insurance in Egypt from any other system, that we are having special EU market taxes and fees that are dedicated for the system. So whether we are not any more dependent on the treasury, this is 1/3 of the revenues coming from that. We are having contributions paid by the employees and employers, of course, and contributions coming from the treasury to subsidize the vulnerable groups, which is about 30% of the population. These are more or less the targets that we are targeting when finalizing the system to reach. We are expecting, or we're having a target for the out-of-pocket to decrease from the 60% to 22%. We are targeting treasury finance to reach 37% for the vulnerable groups, and to have a sustainable reserves at least after 41-42. In a glance, this is Yohia's current situation after 6 years. We are having an accumulated surplus of more than, I know that it's more than 200 billion currently. The total investments of 170.
On this point, I think I agree with you. The context of my presentation was the color and the evolution, because now we are moving, we have reached a stage of maturity. Without fee-for-service, we would not be where we are today. That's the reality. In fact, it was through fee-for-service that we had venture global providers that started coming into the country and investing, because there was an incentive to do that. That was the first part. You had the Cleveland clinics, the American hospitals, the German.
So everybody came in here because the fee-for-service started to push the onus of that investment. At the cost, at that time it was at the cost of the insurance industry, because they didn't know how to write health insurance and they all burned the capital. But it helped in a way because we grew. Today we have all the beautiful hospitals, the best hospitals here. Number 2 is the fact that facilitated good quality data. When you move straight to capitation or others, you will not get the granularity of the data you get for fee-for-service. So that data is now there so that we now can swim through the oceans of moving away. So I don't disagree with you. It's not one size fit for all, but my presentation was primarily around the development within the GCC.
Beautiful. Questions? Now, you have a fantastic time. You have أختنا العزيزة الأستاذة مي, and we have Mr. Safdar. Any questions on healthcare systems, design of healthcare systems, whether on the modeling level or the operational level? Yes, Syed Musa, go ahead from SHMA.
Hi. So Safdar raised a very good point that he briefly touched upon this, that naturally fee-for-service has a lot of perverse incentives which should be addressed by something that is closer to capitation, ideally value-based, because the risk with capitation always is that now providers are going to cut corners, they're going to undertreat in an effort to try and cut costs. I understand that Saudi is in the process of implementing something similar to accountable care organizations in the US. However, from my understanding, one key difference is that they're not implementing a shared savings model that US introduced, right? So how are they trying to prevent the risk of under-treating patients? And would you have any recommendations personally on how this should be done by other countries?
So the Saudi hub is not here. He was supposed to, he could have probably answered this better than myself because we have been working with the CNHI in the transformation towards capitation. You are right that it is not moving towards that mechanism of savings and the profit share between the payer and the provider. Say that, keep in mind that right now the public sector within the Saudi is working towards a block budget. So it's transforming a block budget into a capitation. It's a transformational journey where they are looking at risk-adjusted capitation models, where you have the accountable care organization, the health holding company, and different clusters, but where there is pilot being carried out as we speak to try and see how can that block budget be transformed into an accountable budget. It's a journey. So those are the first few years where you move in that direction. In the future, what the landscape holds, I'm not privy to that.
Just a quick, I just want to add another quick comment related to risk adjustment and predictive modeling and all of this. If you have two HCC scores, which is the risk adjustment for CMS, that are the same, you could potentially have different performance by providers and different outcomes for the same risk scores. So I say that because risk adjustment, as beautiful as it sounds, and I've been there along with everyone else, is actually not a panacea because we're not risk adjusting the arbitrage, which is in the decisions. And I'm just going to leave that here because I've been doing work on that. And it's tied to incentives. It's tied to precisely the whole thing that is causing the issue that we're dealing with. So you end up going in a circle if you're going to look to risk adjustment. I have much more to say on that. So in fairness, I'm just going to pick it.
It's so healthy to have that. So healthy.
Thank you. Yes.
Who will go next? Yes, Dr. Mohammed Abdel Fadil is a health insurance expert from Buba. He's speaking tomorrow, but he cannot suspend his passion for this topic today. Go ahead.
Thank you. Actually, my question to Dr. May, small question. We have a lack of actuaries in Egypt, as you know. How, if this make a challenge for you doing and controlling your business in UAE, and what is, from your point of view, what is the potential for actuaries in the universal health care in Egypt? Thank you.
This is actually the core of our work. By the end of the day, as I mentioned, we're like a big insurance company. So yes, we do have the challenge of having many actuaries specialized in health. This is the problem. Yes, we are having actuaries now in Egypt, but they are more of a pension side and other products, I would say. But on the health side, and especially on social health insurance, it's still something that we don't have local actuaries working on this field a lot. And of course, we're happy to have a lot of work on that in this sense. So what we are doing currently, that we are already having our consultancies done with more of the international experts doing this for us.
Safdar, lack of actuarial skills in Egypt. How does Milliman is responding? I know you have a few things. I know you have a few things on the ground. You have the Milliman initiatives there and other stuff.
Yeah. In fact, I was just talking to you before the session in terms of how Egypt is an interesting place, and you had your last conference as well 2 years ago. In fact, for the UN developmental goals, our team was in Egypt because we are looking at what Milliman has. In fact, the CFO of Milliman was here a while back, and he just moved out of the room. They initiate working with the United Nations with respect to UN development goals, and this is where we involve a lot of actuaries. Some of them work partially on a pro bono, and some of them on reduced rates to support the emerging economies. But it's a fantastic time for actuaries to look into health insurance and the health universal and massive opportunities, which I think at this stage in the region, we have very few health actuarial fraternity.
I am told the food is smoking outside, but if you have one question, we can take it. Go, Ustad Shakib. الأمين العام للاتحاد العام العربي للتأمين. Secretary General of GATE. Go ahead.
I have a simple question. What is the future of health insurance considering, the medical inflation and the longevity risk?
You go first.
You want
Longevity?
Let him repeat the question.
I have a simple question. What is the future of health insurance considering the medical inflation and the longevity risk?
Right. Got it. I think I have to go back to my initial point with the transparency, because that is a very significant push in the US. I see that as the future of health insurance, where more is going to be shifted to transparency and less insurance, believe it or not, or I should say insurance being pushed to where it's needed. And the transparency is going to be more, it's going to shift. It's going to be more of a loan business. I don't want to get too much into that, but you're going to start to shift the distribution to insurance being contained not across the board, but where it's needed, and where, let me put it this way. We insure everything today, and that is inappropriate. If I go to the doctor because I just need something small, that is not in insurance. Let me give you an analogy. If I have a car insurance, I pay for my oil change, and so on. And so what we're doing with health insurance is we're paying for the whole thing: my car, my oil change, and everything. And guess what? People are taking their cars and doing whatever they want, and you can imagine. And so, of course, that's related to inflation. And I think longevity, that's, it is tied to all that as well. That's a good point. I will just address that by saying solvency. My work, which I hope to be sharing more of soon, is tied to the idea of solvency. And to be able to support longevity, which is a very real thing that is happening, you have to build a solvent system. And everything I am addressing today is ultimately about how do we make the system solvent.
Thank you, Doctor. There is a very specialized session tomorrow called How Does Longevity Impact the Entire Chain of the Insurance Industry? Tomorrow by the President of IAA, Ms. Bouzinna. We are closing this session with a comment on Mr. Shakib's question by Mr. Sefder, and we are going to our beautiful lunch.
I think the good news, Shakib, is that when you were here 10 years ago, medical inflation was double digit. I remember the days where it was 15, 16, up to 20%. Companies were burning capital in the stock market. Now it's gone below, it's a single digit, only 7, 8, 9% on average. It's still high, but utilization management has started the process. Once utilization management, clinical guidelines, clinical protocols, regulatory reform in medical necessity comes in, I do believe that medical trends and inflation will come under control. I just want to finish with the last point. I'll leave longevity to tomorrow. Medical insurance actually is not insurance. It's cash flow management. You cannot make big money in medical insurance unless you have the economy of scale. So you have lower profits, but it's big. Your portfolio is massive. I foresee in the absolute maturity, which will probably take another 10, 15, 20 years, you'll have few health insurance companies only. You cannot be a composite, motor, medical. You need to be a specialist in one area, period. TPAs have a big role, but once the individual companies establish themselves, they will have their own in-house. If you are outsourcing the fundamental focus of your business to another party, how can you manage your health business? So in the long term, I foresee that. I'm not against it. I fully support the great work the TPAs are doing, probably another 10 years, at least 15 years. But ultimately, the success comes when you know what you are managing.
Very inspiring.
Just
half a minute.
Half a minute. This is a great point you bring up, and I'm going to just add that what I'm talking about with the transparency part, that is going to be the opportunity to specialize, to be profitable, and the risk that's shifting to the compulsory that is not going to be that. So in fact, that is exactly related to what I'm seeing.
Thank you, Doctor. With this, we close the session. We are out for lunch for half an hour, and we're coming back with 2 fantastic sessions about solvency and the AI. See you in 30 minutes' time. Thank you.
Came up with basically with a new approach to basically the actual you can say the actual reports is that they actually they went away basically with the FCR, with the financial condition report, which has been traditionally there for a while now, and they brought in separate reports. And 2 of the reports that I would like to talk about today, one is the reinsurance optimization one. This, I would say, this was the very first time which it sort of prompted actuaries to actually think about risk in the way it's meant to be thought of. They prompted the use of probability models. They prompted the use of stochastic approaches to actually model how to actually work out how exactly the reinsurance structure should be optimized. And then on the second report, which is the solvency and capital report. So again, this was something that was always there. Companies had to prepare a 3-year business plan every year, and they have to submit it to the regulator. But this time around, what they did was that they introduced a set of new shocks, stress and scenario testing in it, which had a collection of investment related shocks, of shocks that related to basically the insurance side to capture that volatility. But the best thing about it was actually how they devised the CAT models or the CAT scenarios around it. And that was the very first time, especially for me, who has been working in the Middle East for about 7 years now, I got a flavor of what Solvency II really is. And then, it's when actually you realize that capital is not just about factors, it's not about just plugging in numbers, it's about forming a view of the risk that you bear, of the concentration of risk that you have, both in terms of geography as well as exposures. And if you think about it, so the RBC framework is not really something anymore. It's no longer a purely factor-driven approach. It's now a very intuitive approach. So if I give you a simple overview of the KSA RBC framework, it has 5 components in total. So the very first one being insurance risk. So in insurance risk, what's happening is if you are working in UAE, you probably are aware of how the insurance risk module works in the UAE region. KSA in its current form, in its current solvency regime, it's still based on the Solvency I standard, which is a very aging standard in itself. But now they are slowly transitioning towards a new RBC framework. And as part of the insurance risk component, what they have done is that they have factored in a separate loss ratio volatility module, and then they have factored in a separate CAT module, which covers a range of various scenarios, which if you think about it, they are very intuitive and designed to be, they are also very aligned basically with the Solvency II standard. And at the same time, they are meant to be a very intuitive approach and to cover a large scale of risk exposures that you might have. Investment risk, credit risk, operational risk, all 3 areas, you will see that they are very much now aligned basically with the Solvency II approach to it. And the biggest thing is the asset admissibility part. The asset admissibility part has been there in the Saudi market. It's still there in the UAE market. That is something that they are going away with. So companies will have the option to now have their own investment policy, which again, the regulations have been there. But the admissibility aspect has also sort of collided with it. But now they will be doing away basically with the asset admissibility module. And companies will be free to actually set up their own investment policies to the extent that they comply with the ALM requirements. And as long as they do, they won't be penalized for any other asset admissibility requirements. So now if I talk a bit on the UAE front, so UAE, So the new so basically in 2014, basically when the financial regulations came in, UAE came in with the e-forms, and the current UAE solvency framework, it's not exactly Solvency 2, but it's very much, it's still closer to it, right? So if UAE were actually to go to a RBC framework, it won't be a very big transition for them. Although there have been no indications from the regulator that there might be a change in the current solvency framework, but what has been recently happening is that they have brought in the ORSA, the Own Risk Solvency Assessment Framework, and this is being mentioned in a few other regulations that they are publishing. So, for example, the very first time it got mentioned, that was in 2022, towards the end of 2022. Then they brought in the recovery plan regulations in 2023. Again, ORSA was mentioned as part of it. Then, as part of the climate change regulations, as well as there have been a new document very recently in January 2026 covering the ERM regulations. ORSA has been mentioned in all of them. Now, what I feel is that if you look at the components of ORSA, although there is no inclination to change the solvency standard, but what they have asked for as part of ORSA is that companies do a comprehensive exposure analysis, right? They assess their exposures in all domains, not only by the volumes that they write, but the volatility that they face, and the level of diversification that they have created for themselves in terms of geography, in terms of volumes, in terms of their different regions, or however you may want to put it. But the best thing about it, and the opportunity that I see here, basically for actuaries, is that if you start from the very end, from item number 5, governance and ORSA integration, is that the regulator actually expects the ORSA to be embedded in the decision making that the company does, and how they do business, in how they write or price their policies, and any sort of decision making that they do, right? So the idea is over here is to employ capital effectively, right? And that expectation has been set, and then from there you can actually work backwards. And in my view, what I see it is that if we embed, although there's, again, as I said, no clear expectation of RBC being implemented, but they have asked for stress and scenario testing. And the best thing that, in my exposure basically with these RBC models is that our capital model is basically a collection, or you can say operationalizing the scenario and stress testing. This is what a capital model is supposed to be, and not just a bunch of factors which you don't understand. So this is where I end basically my piece of the presentation, and I'll let my colleagues join in who will expand a bit more about their experience on Solvency II. So over to you, Tobias.
We have Mr. Tobias now from WGTA.
More or less perfect. Hello, everyone. Thanks for having me today here. Apologies that the mid part of the deck is a bit smaller. I'm not very much a tech guy, but this actually means that I can talk about whatever I like. I did not mean to stick to the slides anyway that much. So I have the pleasure to complement a bit the European perspective here. And to give you a bit of an idea, I'm working for WTW consultancy, and I had the pleasure to start in 2009, basically when Solvency II was meant to be set in force 3 years ahead. Eventually it was 6 or 7, which means maybe as a first challenge, not to underestimate the time that it actually takes to introduce a new risk-based capital regime. So this is a bit like my personal business footprint. I had the pleasure to work together with companies, so the larger players in Europe. Not only, but we have also made the experience that it's not just larger companies who do apply for a capital model for regulatory purposes who are interested in capital modeling, but we also have a lot of mid-sized clients who do see a value beyond regulatory purposes in the application of their own capital model. Thinking back of 15 years, that was a very interesting time, and it feels a bit like this is also the same atmosphere at the moment here in that region, where there's maybe some regulatory push towards a new capital-based regime, particularly in Saudi Arabia, but it also feels like this has a landmark character for other countries, for the region in general, where people are getting more and more interested in capital modeling topics. So I actually want to talk a bit about threats, about challenges, about opportunities of capital modeling. Before doing that, let me really quickly say a couple of words of what we actually would understand by a capital model. In general, I would say it's a risk-based model, in a sense, simulation model, simply because reality is complex. And to give you an example, reinsurance for an insurance company, non-life insurance company, is a topic where you would say, well, for each simulation path, each individual version of what is going to happen in a year, it's pretty much clear what's going to happen, how to apply reinsurance. But over all possibilities, this is difficult, and this is why we are working with simulations. When thinking about a capital model, secondly, we would think about something that models a company bespoke risk. So it's different from a standard formula where you would say it comes up with assumptions on a market-wide volatility. And this actually gives you the possibility to ask questions to your model, which means it's the use case that definitely matters for companies to see a value here. Now, what are the applications of such a capital model? So we have basically, wait, that the format is adjusted, thank you. So we basically have structured that here in two ways. So the first one is there are external motivations. First of all, I think it's regulatory interest. So companies might say that we do not comply with a risk profile, how it is prescribed by a standard formula approach, which means if one wants to deviate from that, a bespoke capital model would be an option. Then there are others like rating ambitions to show a certain capitalization to investors, for example. The much longer list can be found in the bottom part, so internal uses and benefits, identifying key business decisions. And there are various topics where capital models can be used for. So say, for example, asset class optimization, asset liability management in general, or the one that I would like to give that I would like to talk a bit about in the subsequent minutes, that is reinsurance optimization. So let's talk about reinsurance. From an insurance perspective, what reinsurance is about is basically it's reducing risk. It's reducing the amount of capital that is needed to comply with solvency conditions. Now, does that actually mean that the more reinsurance, the better from a company perspective? Eventually not, simply because you're not just sharing risk as a primary insurer with your reinsurer, but you're also sharing profitability, which means it's definitely worth asking the question, what is the right level of reinsurance, right? In a sense, like what actually complies with your own risk strategy. And a capital model actually gives me the possibility then to quantify that effect. As an actuary, one would usually call that an economic value added. If you compare the benefit of a capital model in terms of reduction of risk capital in comparison to the profitability that you're then sharing with your reinsurer that is ceded. The point I actually want to make on that slide is not that we have plenty of nice charts here, but the fact that such models do exist already to analyze the impact of reinsurance on a company's gross net profile in order to obtain a net risk profile. Which means, other than, let's say, in 2010, in Europe, Solvency II being still a couple of years ahead, meanwhile, such models do exist and can directly be used out of the shelf, rather than to start into the implementation, which just might take longer. It will, of course, still mean for insurance companies to calibrate their own models, to calibrate their own risk profile, but having the data ready, having the technical setup ready can definitely be seen as an advantage here. Now, thinking about risk, actually there are various stakeholders in a company who are interested in in risk or risk management in general. From a reinsurance perspective, you would say it's the reinsurance manager, and the reinsurance manager has a has his own terminology, has its own scope when talking about risk. Now, at the other end of the ladder, there might be a CEO, for example, thinking in terms of risk more like what is going to happen between one balance sheet and the next one, something that should be smooth, completely different understanding. And what I would like to highlight here is the role of actuaries. Actuaries do play a very crucial role in a company's process in order to foster an alignment between the different stakeholders, the different parties, and to just simplify or allow for a smooth communication. So the actuarial team is basically the part that can make the whole system spin and encourage the different parties to engage, simply because from a use test perspective, the actual application of a model, the more stakeholders are involved in running a model, the better the quality of the model will be. So as a conclusion, maybe two messages. First of all, risk modeling beyond the calculation of a capital requirement offers a lot of opportunities here. And as a second point, please trust your actuaries, get them involved in the process, and give them the confidence for them to do their job and hence to enable them to play an active part in risk management. Thank you very much. I think I'm not the only one who wants to talk about the role of actuaries, so over to you, Paul, then.
Thank you, Mr. Tobias. Thank you. Our Mr. Paul Tono, the President of Indonesian Actuarial Association.
Okay, thank you. So firstly, I would like to thank the organizer for inviting me. My name is Paul. I'm the president of the Society of Actuaries in Indonesia. We are the fourth largest, most populated countries in the world. We have population of nearly 280 millions, and we have the very fast in terms of percentage growing actuaries. Our members are close to 1,000, it's 900, but we have now 40 universities offering the actuarial specialists. So that's, I think, the graduate itself is like more than 1,000 a year. So we're rapidly growing of actuaries. So I think this topic will be interesting. So when I was asked to speak, I chose this because I think Takaful is also interesting. It's growing in Southeast Asia, and also will be one of the interests for the actuaries in the Middle East and North Africa region. I was previously worked in several companies like AXA, Pre-UK, and also Cigna as a C-level, mainly Chief Actuary, Chief Financial Officer, and Chief Strategy Officer, and also doing business development. Now I am also advising some of the AI companies, focusing on the insurance, and also working as an advisor in some insurance company, doing the M&A and all other stuff. So I think why Takaful is important in the world, although the percentage is very small now, but I think it's growing rapidly. It's very important because, as you know, the Sharia-based principal insurance is the MENA area as 90% of the population of Muslim. In Southeast Asia is more than 40%, but it's dominating more than 80% in Indonesia, Malaysia, and Brunei. And in Philippines and Thailand, they are also looking to offer the Takaful products because they are main minority. Then I think in Thailand and Philippines is like 15%, but they occupy some areas predominantly. So I think that's becoming more important and important. Also in the world, you see the growing population in India, although it's 15%, but it's from 1.5 billion people. So the number of population of the Muslim is also increasing, including the Pakistan and Bangladesh are their majority and increasing quite rapidly. But the takaful business is not only for the Muslim, but also good for non-Muslim. And what make it unique is because there's a hybrid approach of between a mutual and stock company. So you are splitting the risk portion into the financial pot into the risk pot that is not touched by the operator. So the combination of it, the hybrid, make it a very unique, including from the risk perspective and also the capital perspective. So I will talk more and I will discuss about how to approach the capital of the takaful or the Sharia business. But it's important. And why it's benefit? What kind of benefit that the takaful bring? Because it's a combination of the economic value. Of course, as an insurance, you need to control risk. The control risk is introduced for the Sharia or takaful is by sharing the risk instead of transferring the risk into the insurance company, but sharing the risk among the participants. And it also gives universal value. What is the universal value is a good feeling. So meaning that if you don't pay claims, you are basically helping others. And also by the takaful principle, it's not stopping you to contribute more. So it's a combination between you give donation and also you help other people as well as protecting yourself through a risk sharing. That's make it a very strong and unique characteristic of the takaful insurance. And also religious value, as the Muslim people, they avoid to do what we call riba, goror, and maisir, and that's also is prohibited in the takaful business. So there is no interest-bearing investment. There is no win or lose or gaining some money, or also there is no probabilistic idea of risk. So that is, I think, what does it bring. So what are the opportunities in the takaful business? One is that it's the combining of the insurance and social donation. So you see in the world there are also ideas of doing this hybrid. One of the example is the company called Xianghu Bao is owned by Ant Financial, and because it is very successful, it is closed by the government only within 1 year. But only within 1 year, they are already reached like million of participants. So how they do it is they donate some money, and then that money is using into the pool fund, so that if you're deemed critical illness, you are helped by the pool fund as well as you help others using the pool fund. So that is very powerful campaign in China, and also being used by in Indonesia. There is new company called Saling Jaga. They also use the same concept. So basically, it's a combination of people donating. So you get the gain not only in the world but in aftermath as well. So and the concept is actually used also by a US company called Lemonade. So Lemonade is also using the hybrid concept. So they are saying they are mutual. So they are pulling the risk together. If there is a profit from the risk, they distribute it among the participants. So the company is only acting as the operator. So sharing the risk also that means that the opportunity means sharing the risk. You can go into the uninsured, because for the insurance company, sometimes I'm grow in the life industry. Like for example, if people with history of heart attack or people with history of cancer. Usually it's uninsured from the insurance underwriting standpoint because they don't want to insure people with history of heart attack. But with the takaful business, you can do that because you are mainly sharing with the same pool of risk. So if there are 1,000 people, 10,000 people already had heart attack before, they can share the risk. And after you have heart attack, doesn't mean that you don't have risk. You still have health risk. You still have risk of cancer. You still have risk of stroke. There are many other risks, but insurance company don't want them, so they can share the risk among them. So I think that's the opportunity, and also because there is an element of social. Then if you are doing in the closed loop, there is also lower cost of fraud because it's not between insurance company and the participants, but it is the sharing of risk between the participants. So if you are doing a fraud, basically you are stealing other people's money, not the company's money. And we are introducing that concept into the Indonesian court, and they can accept it. So now in the Sharia business, in takaful business in Indonesia, if there is a fraud, we have bigger probability of winning in the court compared to the conventional business. And yeah, the last opportunity is the universal value. So it's a good feeling. Doesn't mean that you don't claim, you get nothing, but you help others. But there also come with threats. So the interpretation of the takaful business is relies on the interpretation, and some of the interpretation may be contradictory one another. Like for example, whether the surplus underwriting is distributed among the participants only or between the participants and the operator. And also the cost of the double compliance, because you are not only need to comply with the regulator, but you also need with the Sharia principle. So there is a cost on it. And limited human resource, not everybody is well versed and understand about the takaful business, and some regulations in some area, including Indonesia, is still not really supporting the takaful business. For example, that the surplus underwriting is treated as a dividend, so you need to pay tax for the surplus underwriting. That's one of the example. Another example is, although the risk of the insurance risk is separated and the operator is not gaining the underwriting risk, but the operator still need to pay for the underwriting risk capital. So that is, I think, the discrimination against the takaful, but I think those are what actuaries should be advocating for. And the last slide is what are the role of the actuaries in the takaful, that as an actuary working in the insurance company and in takaful, you need to consider the participants as the big stakeholders. Now, the actuaries still think that the biggest stakeholders are the shareholders. They want to gain profit as much as possible. But with the takaful business, you need to put a balance that the participants are a big stakeholder. And then the actuaries need to remind the companies that their role is an operator. Operator get a fixed fee instead of the profit as much as possible. So that is the role that the actuaries need to advocate continuously to the shareholders. And then similar thing, maintain neutrals. When there is the pool of risk have different state compared to the shareholder fund, needs to be maintained the conflict of interest. That's the role of the actuaries, and uphold high standard of practice. Indonesia already launched, the Society of Actuaries already launched the standard of practice of the actuaries working in the takaful industry. And the last is the advocate the regulators to make it less and less discrimination about the takaful, and also to advocate that actually with the takaful, insurance company is just the operator. So the risk is shared among the participants. So they should get the benefit of the capital, because the underwriting risk should be less, because underwriting risk is borne by the sharing among the participants instead of borne by the operator. So I think that's it, and I welcome if there are questions and discussion. Thank you.
Thank you, Paul. Thank you very much. Presentation with Mr. Kamil Hassan from Institute de Actuarial France.
I'm going to share with you some work of the French Institute on the risk mapping. So, as a risk manager, we all believe that a sufficient risk capital starts with a good risk mapping, including, of course, the new and evolution emergent risk. So here is the thing. With the French Institute of Actuaries, we conduct every year a study to develop and share a market-wide view on the key risk factors. This first to get everybody in the French Institute at the same level, at minimum vision of risk capital and risk factors. Of course, this task is becoming very challenging in a moving economic, political, and environmental world. Some few insights on our objectives. The study is actually a survey, and the main objectives are to compile first the main driver of the business, intending by business the premium and claims collect. And we also, in our survey, ask for and try to identify the risk factors at 1 to 3 years. And we ask for every participant to give us his insights on his own line of business. So here is the scope of the study. We have life and health insurance, and both P&C and casualty insurance. Let me up. I'll go quickly to tell you that this process timeline is based on 3 months' work, and we try to make a communication every year as fast as we can, but mainly on the second part of the year. So here I come to the first result. If you come back to the year 2024, this is the main insights of the business. It was an increasing year regarding premiums and claims, and this trend was mainly shared by every participant. Behind this, we try to identify, we ask them, what are the main drivers by line of business, and here are the main results. Looking for property and casualty, here, let's say that premiums and claims are mainly driven by the economic environment, as we knew a huge increase of inflation in 2003 and 2004. Now it's start to decrease and change or can move the drivers. But we'll see also that there are like climate change and other main drivers. I will see later. This we'll see later. And here you can see regarding the risk factors, the vision of the participant for a 1 to 3 year horizon. So again, this is an exercise, and the participant mainly for a life and health insurance. Are all agree with the fact that the regulatory changes is a subject, is a real risk factor for the French market. And of course, we find again the economic environment, which includes the macroeconomics and of course the financial factors. So here, it's a point which is very specific, I mean, for France and Europe, which are driven by regulatory changes which can affect our business. Regarding P&C, you find again the economic, the climate change and natural catastrophe, and also a commercial subject which linked to reinsurance impact and capacity. Some insights on our market. So insurance in France is representing 280 billion of premiums a year. And here I have the disclose between life and P&C, and you can see that the main line of business are both life and capital accumulation for the LNH premium and the professional goods for P&C premium. So I'll try to zoom quickly on that line of business. Here are the more details about the drivers. I don't say a lot. Here are the claims still for savings and retirement. You see also the technical development of the portfolio, which impact naturally the movement on the line of business. Yeah. So here we are, the savings and retirement contract. Asset under management for France is 2 trillion euro. 2 trillion of euros as January 2025. Here you can see the evolution of the last years regarding premium in blue line and surrenders in the red line. And down you have a real subject which is the net inflows of the business, and you can see we came back at a positive situation in 2024, but the market has some difficulties of liquidities in 2023, and moreover on the capital guarantee euro fund we are still in negative net inflows. So naturally we will find the illiquidity risk in our mapping. Here we have an example of regulatory changes which came in France in 2019 with a review of the law regarding the voluntary retirement, and we can see the impact in a few years. The law was voted in 2019, and we can see from 2020 the level of GWP, which is the blue here for the individual scheme voluntary, and we can see that it has increased per 3 in few years. So here we can see the positive impact of regulatory changes, and we can see also the level of impact. So it depends of the way of the change, but it can be very positive on impact or very negative. I try here to share with you a positive situation. Other indicators here is that the business of retirement voluntary scheme represents, let's say, only 125 billion, which is less than 7% of all the asset under management in life insurance. So still a lot to come on this business. What is important to notice for France is the part of the position of these voluntary schemes, which are coming to increase regarding the situation of the basic mandatory scheme. We are in a situation, it has been said this morning about demography. Everybody knows that there is a tension on mandatory retirement. So the role of the voluntary scheme will go rise, and this is actually an opportunity for the market. Here we come to the results of the survey for risk factors on 1 to 3 years. And you can see the movement between 2024 and 2025 survey with the illiquidity part of asset, which changed position and came at the 3rd place in 1 year. Here, because what I said before, we had the use subject on net inflows in the life insurance. Regarding cyber attacks, it comes now in the top 5 risk, which was not the situation before. So in 2025, we find again the subject of the interest rate. It has a real impact this 3 years on our business. The impact of changes to regulatory and particularly the savings project taxation, which is a subject political in France right now, the illiquidity and the equity market shocks came before the cyber attack. Here is the main risk factors identified and collected during this survey. I share with you, you can see that mainly it's financial and market factors, but the regulatory changes is a real top risk factor in our top risk assessment. I go fast. If I come to the PNC and particularly the professional scheme, here are the results of the trend. The business is still increasing for all the participants with the less speed, than 2024. And the main drivers are still commercial strategy and economic environment, followed by the regulatory changes. Regarding the claims, we do have the climate change, which appears as one of the main drivers because of the last year catastrophe in Europe and especially in France. But in 2024, let's say we do have a small decrease. Yes, okay. So I'll go fast on the main drivers I shared. Here are the main risk factors. As you can see, the climate change natural catastrophe is now the first subject for insurers regarding the PNC and professional engagement and guarantee, followed by one subject, which is the reinsurance impact position of the reinsurer following the engagement of insurance. We had a huge subject in France about this position, about the pricing of reinsurance, and about the scope and limits. And finally, we do have as a third position the economic environment, still including inflation and interest rate. Yeah, if we look at the risk landscape, the survey insights and emerging challenges, we found those main risk factors we have to address and manage for the next few years. Markets, liquidity, inflation risk, sustainable and ESG, geopolitical and AI. What we say about AI, as we can see in the last few months, some subject with the reporting, but we do also look at the customers analytics, the governance, the AI used for governance tools. And in PNC, we'll find, of course, the climate, the claims underwriting inflation, the legal liability, the cyber risk, the insurance availability, and again, the AI for different purposes, which are algorithm bias, cyber exposure, and model robustness, including pricing. To conclude, what I can say, and as you saw, our risk can be singular, but most of them are shared. and the collaboration with mutualization is one of the solutions to mitigate our risk and guarantee covering for everyone. So thank you for sharing this moment.
Thank you, Cam. We're lucky we have 10 minutes to get some questions. I have one question. Since I am ex-regulator, I am worried about insurance company board. I have a question concerning the capital frameworks in different regions. What are the main implementation challenges for insurers in your region, from your experience too? So, can we see the other side?
I think if I can comment on what the capital regime looks like in the Middle East, we would see that a lot of companies, a lot of regions or a lot of countries, they are still based on the Solvency I regime. What KSA has done, KSA has taken a very drastic move, and directly from Solvency I, they are attempting to jump to Solvency II in a matter of 1 year. So the plan is that by the end of 2026, they will be moving to a full RBC regime, which would be very much like the current Solvency II regime. Companies will in fact have the option to actually shift to their own internal models, which is something I think companies who are actually operating in the reinsurance domain or have business outside, based in more than one country, they ought to consider it. But as far as the implementation challenges go, we need to consider the fact that much of these companies are medical and motor dominated, right? And the biggest challenge actually comes to companies who have a sizable exposure, in my view, basically towards P&C, property and engineering. And in that case, the capital charge, it really goes up. And if you compare it to basically the traditional Solvency I regime, it's actually a very big shift. So yes, will companies comply? So obviously the operational challenge is there to move to basically a factor, from a single factor regime to a multi-factor or multi-domain RBC framework. But at the same time, if under the Solvency I regime you have a solvency ratio of 300% or 400%, you move to a solvency ratio of 125%, or in the case of some companies, it may get lower. Then obviously that is another challenge.
Thank you, Shiraz. What about in Asia or Europe?
I think one of the biggest challenges for the capital regime is because capital calculation is never perfect. So the best way maybe for the actuaries are to do like ever-changing stochastic economic model with 10,000, 100,000 scenario of Monte Carlo simulation. That's, I think, this should be the ideal way. But I mean, one is not implementable. Second is for the regulator also to supervise is not easy. And the third is they are prone to the model and operational risk, which may not be good as well. So I think that's the challenges. So the regulators, when they make the regulation, they need to prioritize based on what are the biggest risks according to them. So that's make that some of the companies that is actually manage the risk well may not be rewarded well by the capital regime. For example, in my area, there are reinsurance company that has perfectly diversified the risk between like or marine cargo and life and also the fire, but it is not shown in the capital. So they are being penalized by no correlation in the capital for the sake that the regulator is trying to find easy way to supervise the insurance. I think that's the biggest challenge.
Thank you.
I think there's one aspect to it, namely that changes take time. So the calculation of Solvency II in Europe did not mean to now actually perform the calculation of quantitative reporting templates who comply with the reporting like was demanded of the regulator only, but it was more like a change in process, new governance, and just ideas to to change in people's minds, to come up with another level of risk awareness, and this to be actively embedded into a risk management culture.
Quickly, I would say for EUPA, it's mainly to not take 10 more years to correct or adjust the risk management, and also the level of shocks, and also the scope of risks. As I said before, now we are including some climate and sustainability impact, but we do have some future risk. We are not so future when we talk about cyber and operational risk. When we talk about illiquidity, we're talking a lot from volatility on the equities, but those are still to impact and to treat maybe more with more details. Yeah.
Very interesting. Always we have risk. Please, we welcome questions on the subject matter. Do we have a question from, please?
Hi, thank you, everyone. I had a question for Mr. Paul. First of all, thank you for the insightful presentation on Takaful. I think the beauty of Takaful is that it splits the risks between the Takaful fund and the shareholders fund, right? So when we talk in terms of capital modeling, especially risk-based capital modeling and solvency regimes, how do you propose that these models treat this unique treatment of Takaful as opposed to a conventional fund? Because obviously you have the same fund, you have the same capital models on all of the risks, but in Takaful you have two funds, we have a split of risk. So how can capital models and risk-based solvency regimes treat this adequately?
That's a $1 million question. I also don't have the answer, but I think when we split the insurance risk and other risk, operational risk, into two different buckets, and the insurance risk is actually shared among the participants, then there should be a mechanism where the capital should be held by the insurance pool of fund portion, and so that the operator is only subject to the operator risk. There is a concept called CORT, which is Qort al-Hazan, which means that the operator should lend the money should that the insurance pool fund is not enough, and the loan should not bearing any interest. Also, there is, in terms of the actuarial world, there is also a risk borne by the operator. But I believe it should be separated. So that's, I think, more like the role of the actuaries to have the insurance risk as the continuous lifelong life of the insurance pool of risk, rather than looking at the short term how to take the benefit of the underwriting gain. So I think that's where the actuaries need to play important role, and unfortunately not everybody, including the Sharia scholars, understand about to manage the risk and the capital of the Takaful.
We have another question, please. Microphone here, in the front.
If you allow me to make a comment in response to the gentleman. In fact, there was a controversy about this aspect a long time ago, maybe 15 years ago. And at the time I was the vice chairman of the Global Takaful Association. The IFSB, the International Finance Service Board, based in Singapore, they edicted a kind of, let's say, a directive or regulation. They wanted to commingle both funds, the policyholder fund and the shareholders fund. But the reaction from the Takaful companies, especially from the shareholders mainly, they said no way to do it this way. And they remember I was one of the people who opposed this directive. And I think, honestly speaking, the Qard al-Hassan, as you say, it's a solution. However, it's until now, in my humble opinion, it is not solving the issue definitely. The Saudis, they did something which is, I think, very positive. At the end of the year, there is no way to use the Qard al-Hassan. The shareholder should bear the deficit. They will pay for the deficit, full stop. And this is, I think, it's in terms of, let's say, sustainability of the takaful model, I think it's much better than let's say, using this Qard al-Hassan, because Qard al-Hassan, you keep reporting, but until when? And this is the real problem. I have just a quick question for you. And because till now, I don't have, let's say, the answer at the accurate. What makes the pricing in takaful different from the pricing for conventional? And this is an issue. I will tell you why I am asking this question. If you are talking to the Malaysian actuaries, they know exactly why the pricing is different, and they know the difference. However, in this part of the world, I mean, especially in the GCC and even in North Africa, people, they keep pricing the same. Thank you.
Mr. Paul, there is a difference?
Yeah, okay, thank you. There is actually, the principle are the same, but I think that's the role of the actuaries to improve the economic value of the takaful so they can price cheaper. How to do that is by reducing the cost of fraud. So we believe that there are frauds everywhere, and the cost of fraud are already priced in the conventional pricing. But because the takaful is a religion-based and also a universal value help each other, we should have a belief that the cost of fraud is less. So that's where the takaful business may have an advantage on the economic value. I think that's what I can say for now, and that's important for the actuaries to really understand what is the cost of the fraud and abuse. Like for example, it's very obvious that for the health insurance, I mean, if you are in the conventional business, then if you go to the hospital, the doctor charge you skyrocket abusing your insurance company, then you will accept its benefit for you. But in the takaful, the peers and the person who is sick should have the tendency to maintain the pool of fund, to not jeopardize the fund. If the doctor says, oh, you need to do test A, B, C, D, then they should say, oh, what is the really needs? Then they just maintain what is really necessary to do the diagnosis and to do the procedure on the health. And also, I think whether it's because it's religion-based, whether you believe or not, if the peers are praying for the sick one to recover, they will recover sooner. So I think that's where the cost of fraud is less, so that you can pay cheaper.
Thank you. We came to the end of the time allowed to us. So please, I would like to thank our panel member, and thank you for your listening. Thank you.
Ali. I'm from WTW, and I will be sharing today the panel on transformative impact of generative AI on actuarial work. Our objective today is not to speculate about distant future or dramatic headlines, but to discuss what is already observable in practice, how actuaries functions and evolving today, and how this development can be implemented in a way that preserves professional judgment, accountability, and appropriate governance. We will keep this session structured and active. We will start with a very short concrete illustration to ground the discussion, and then move through a small number of focused questions. So I would like first to welcome our panelist, Zuhair. If you can introduce yourself. Yeah.
Hi everyone, my name is Zuhair, managing partner at Master Actuary. I'm also a qualified actuary. So at Master Actuary, we're providing actuarial solutions, so genome pricing, portfolio monitoring, customer price optimization, and quite recently, generative AI application for actuaries.
Yusuf?
Yeah, Assalamu alaikum everyone. I'm Youssef Saidi. I am partner within Exxon Partners, which is a French consulting firm that is acting in actuarial science and transformation. I'm very happy to share this roundtable with you guys to speak specifically how we can turn the promise of AI into tangible reality in the actuarial function. And then, I'd be happy to discuss maybe two, in my opinion, key questions. The first one is how to, or at least where does AI has the most value creation in the actuarial chain, and then how concretely we could, as actuaries, implement this in the field, knowing, of course, all the very real barriers everyone can foresee, and we already seen some ones this morning.
Frank?
Good afternoon, everybody. My name is Frank Scheppers, and I'm the global leader for WW's insurance consulting technology business. I think my qualification for being on the panel today is two things. I'm an actuary by training for 30 years. I started before we had email. If you imagine that. So I came to the office, no email. We didn't even have Excel. So I started working before Excel hit my desk. And the other one, I was involved a lot in the actuarial training for the German Society of Actuaries. And happy to share the stage with you guys.
Thank you. Zuhair, may I ask you to start the illustration? Yeah.
Give some example which shows how GenAI can help us. So we got some people, some actuaries, some executives at our booth, and when we need some figures in the company, we often ask the actuaries to do that. Most of the time, it's figures we can have quite easily. We know how to do it. It's just that it's time consuming, and it's honestly quite boring. So I want to show you how you can do that using generative AI. So here, let's say you have someone asking you what is the latest profitability of your company. So you have, for an actuary, you have to pull the data, then you have to generate a graph, then you have to send an email. And we do that again and again. And now, actually, you can just ask the question. And then you have an agent AI, which quite automatically will do that for you. Let's see here. So you see, let me just maybe play again. Okay, so no, not a good idea. I don't know how to go back. Well, I think that is good. So I just ask the question to the generative AI, and I get the answer very quickly. So if you have to do it manually, it will take at least some dozens of minutes. But now, with generative AI, you can do it quite quickly. So we know how to do it, but just that AI will do it exponentially faster. And for us, that's just a way to go faster with exactly the same result. So we can have some other application. So let's say I want the average cost, for example, for a nurse insurance project. And I want to show it per job activity. So let's see what it gives. So again, we're just asking generative AI to generate that. We're not going to do it by ourselves. So that's for a nurse insurance, right? So here you see the average cost by job. So basically we have 300 jobs and we don't see anything. We don't know what to do with that. So I think for many of you, it's the same. You have all the job. If you're on an health insurance project, you don't know what to do with that. You may have, if you're on car insurance, you may have all the models of the car, but you have 1,000 different models. You don't know what to do with it. So most of the time, we don't use it. So one idea
is to ask that generative AI to somehow group it into a way that is more relevant to us. So here, I'm just asking that generative AI to group it in a way that makes sense for health insurance projects. I won't do it manually, because if I have to go through every 300 different jobs and put it in the right group, I would spend hours doing that. So most of the time, we don't really use that type of variable, which are somehow unstructured. And then you can see you have a mapping from those 300 jobs to some group of jobs which makes sense. Now you can see the average cost for construction and logistics. It's much higher than intellectual, professional, and administrative, which makes sense. So it means that we can create some value from generative AI. If you're on health insurance, you may want to rank the job by their level of stress, for example, and you can use it to price it. If you're working on car insurance, you have all the thousands of different models. You don't know what to do with it. You don't use it today, price it. But you ask the AI, okay, for each model I have, give me what is the level of driving assistance of that car. And then you use it to price it. So it means that it opens somehow new horizons, that we are now able to use variables that we were not able to use before. And so we can now use unstructured data in our rating factor, which is quite new and which is brought by the generative AI.
Thank you, Zuhair. I will now start with our first question. What are the concrete and observable impacts of generative AI on the actuarial function today? Can I ask where to start with? Yusuf? Okay, Yusuf, can you start?
Yeah, thank you for the question, and I think Zuhair has just showcased a real case. In my opinion, AI is, or at least generative AI is already there. It's no more, let's say, fiction. But maybe some cases have been discussed this morning, and I just showed one. I like to maybe have 3 examples that are really, let's say, revolutionizing the actuarial profession currently. The first one is, yes, related to the pricing, as you just mentioned. What, let's say, takes currently days to the traditional way to an actuary to build, for instance, a price on the P&C side, on the P&C business, now is really something that can be automated in few minutes, 1 hour, the maximum, by AI. So all what is related to detecting the key variables, building the coefficient and fitting the coefficient of GLM, backtesting the results, benchmarking the prices regarding the market, now is really something that is handled 100% by AI agent. And this is, as you said, exponential. The second one may be also example that I like to and I have seen within some European insurers is all what is related to the regulatory production, related to financial statements, to prudential statements. We all are aware of the burden of IFRS 17, of Solvency II in Europe, etc. So we already see end-to-end processes that are handled by generative AI, from complex computation until the production of presentation to executive committee, which is, I mean, really, really impressive. Last but not least, maybe, and I'll finish with this third one because I like it very much, is always is related to the client experience and specifically how to make the insureds have a clear and fluid, for instance, claims management. We already see some AI agents that are able to predict cost of claims and redirect insureds to to handle their claims automatically, which is quite really revolutionizing in terms of timing.
Thank you. Zuhair?
Nothing to add. I think you said everything. Perfect. Thank you.
Yeah, sure. I would like to give a slightly different perspective then. If you ask me, where do we see AI? We see AI in pricing. Yes, we see for the last 10 years. Yeah, machine learning is a kind of AI, and that is used. Yeah, we see it also in claims management. Nothing wrong about that. When we look at the Gen AI, is that would any insurer say we use Gen AI to come up with motor prices and deploy them to the markets? Nobody would do that because nobody would trust that. Nobody would say, yes, everyone would say we need to have a human in a loop, and the human needs to make sure we have the right price to it. That is stopping from it. When it comes to the financial reports, I think the point is on data ingestions, that's easy. So you got unstructured data or you got Excel files, you want to have that. Their AI is a big help. You want to write reports. Yes, we're also doing that, but that is already at the advanced side. I also don't see too many companies doing that. Everything in the middle, where if the CFO asks, who has done these data? And then you say, okay, we have produced these data with AI workflow. Every CFO I know would say, really? Do you really think we can use these data? Who has checked that? And so that is a bit like, I think we're still in between that, testing out what is possible in theory and what is really already trusted and used in practice. And the question is, how long will that transition period last? Yeah, so will it be 3 months until we're uncomfortable? Will it be 1 year? Will it be 3 years? And I think the jury is out on that.
Thank you, Frank. That will take us to the second question. To what extent are actuaries going to be replaced by AI agents? Zohair?
Well, so what actually will change with the AI is right now we actuaries, we are doing a lot of things, sometimes very late at night. If you're a pricing actuary, if you're reasoning, sometimes we finish just very late. We don't have time to check. We do things and we spend little time to check. Now the things that we do now, I hope that in some future, is going to be replaced. And we will spend less time trying to do things, and instead we will spend more time trying to manage things and check things. It's somehow like everyone is going to be an actual manager because they won't compute Excel files, they won't concatenate Excel files. Rather, they will try to manage those AI agents as you would manage, as an actual manager now would manage his own actual team. So you have always some weakness and strengths within your actual team. And that's, I think, is what is going to be. So you will still need an actuary to manage, to supervise those agents, and to check that they're doing the right work, as an actual manager would do with an actual team.
Thank you, Zohair. Yusuf, what do you think?
I see it not as a replacement, but rather a kind of augmentation. We have augmented, let's say, actuaries. I have a story about this one because last year with Samuel, who is here, we presented at the French Actuarial Congress an AI agent who was capable of building a GLM, building a price, and then predicting the cost of a claim on the motor business. And I can remember that the first question we got 1 year ago already was, are we going to be replaced? And exactly the same question you got, Mohammed. And I really think the question it's not really the question because, as has been said, and I agree, Frank, is that generative AI is really a kind of tremendous opportunity to make the job of actuarial more important than ever in the insurance companies and banks. So here we have this opportunity of having the responsibility of explaining the models rather than computing and testing, etc., and being really the guardians of the mathematical models and the technical skills and technical foundation. So I really see it as a big opportunity for the ones who embrace the change to boost, I would say, the career in the financial market.
Thank you, Frank. What do you think?
Yeah, I think I agree with all of that. I'm not sure which of my thoughts I want to express now. So, I mean, I think it's important that we say what is the purpose of the work I'm doing. If it's about giving a price to a customer, you need to be highly sensitive. So that's a big barrier. If you want to report financial numbers, high barrier. If you want to say, I want to have scenario testing. I want to support an internal decision. I just want to analyze something. I think then it's also much easier to say, okay, let's ask the machine. The machine comes back with some of the possible outcomes. Then you will still have somebody to look over it. But I mean, I agree. It's like it's an augmentation. It's like you have a whole army of interns working for you. And then the question again with the timing is then, well, how long will it take until the army of interns will be an army of 3-year experience or 5-year experience? So what is the next step in that? So I think there's a real hope in that AI will help a lot with the shortage of actuarial talent. I don't think it will replace it.
Thank you. This will take us to our third question. What is the skills that future actuaries could have in an AI-enabled environment? Zahir, what do you think? I think first, so as I said before, I think those will have some AI agents working for you. So as I said, you need to know them. What are the strengths? What are the weaknesses? And you can be pretty sure whatever AI you're using now, just for the simple example that I did just before, sometimes just ask an AI to group some job, to group some nationalities into continents, for example. And quite surprisingly, sometimes just for 1 or 2 countries, it might make an error. So we need to know the strengths and weakness of each LLM model, I think. And then, as I said, being able to manage this, how do you manage multiple AI agents? How you can be sure that at the end, the work will be done as you would. And I think maybe specifically with our actuaries, right now we're quite concentrated on the data, and then maybe we will be less concentrated on we're less focused on the data, rather more on the business impact we might have, and that we can add to our pricing practice. Yusuf?
Regarding the skills of, I like to call it an augmented actuarial analyst. First it is a new layer of responsibility that is explaining results that have not been produced by yourself. I think managers know it a bit already, but now more than ever we will have this risk of having this black box syndrome of having outputs from a box that we cannot understand really. So here, specifically, actuaries will have a role, and they will have to develop these skills as they will be accountable for the results. They will always be, as I said, the guardians of the mathematical foundation. So yeah, it's very important to really have this in mind. Now, just maybe in terms of in a very practical way, what we foresee is maybe, and it has been discussed this morning, we will hire more and more people that are able to write correctly prompts to generate accurate results that are relevant regarding the problematic, the actuarial problematic. But also, what will be key is to have this ability of using different platforms, different language models, to, for instance, be able to produce the results with a specific agent, specific model, and then to validate it with another one just to make sure that we have optimized the actuarial experience. Yeah, and of course, this is very important for actuaries in general, is really the pace of the changes and of the technology is very quick. So keeping this mindset of continuous learning and staying curious will be key more than ever.
Thank you, Frank.
Yeah, I think you made a very good point about that. Large language models, which to use, don't rely on one. I think it will need insurance-specific large language models. So it's like, I think if you just work with ChatGPT, it won't be good enough. So you need to train that up. The other one also, well, I already said that I started before Emo was there. Another thing was also, I was doing calculations and I used them to go to print it out, go to the next room. There was my boss. and to show whatever I'd done to my boss. And that was like, so I was working a full day on that, and I gave that's the table of results, and he looked at that and said, Frank, look at that again, come back with the right figures. So even though he has not done all of that, just from experience, he could tell that can't be right. Yeah, and then I went back and said, yes, some errors in that, and I redid that again and came back to that. I think that will be the challenge for everyone involved in there. So you got your augmented actuaries, you got your army of students working for you, and then you need to say, does it make sense, does it make sense? Do we have all the assumption slides? Are all of the connectivity between things, is that all reflected in the correct way? And it's not only that you have to do it, but you have to do it in a very, very high speed. So I think that's, for an actuary, it's almost like, it will be quite uncomfortable, I'm afraid, because all of the work which was boring will be replaced by AI. That's great. You don't have to do boring jobs. On the other hand, the very demanding jobs, they will come to you in a more frequent way. And you will say that's exciting, that's good, but it will also be challenging. Say, this is now the answer, it doesn't come from Youssef, but it comes from the AI. Oh, I know Youssef, I trust Youssef, do I trust the AI? I think that's probably the biggest hurdle.
Yusuf, what do you think? Sorry, Frank, but yeah, the data is key, however, in my opinion, because you cannot build intelligence over weak foundation. So, and we know insurers, banks have these multi-layered IT systems, sometimes for data quality. And of course, if in my opinion at least, having effective AI solutions, one of the most important prerequisites is having a data workflow that is clear, data that is as much as possible clean. I know this is a challenge, but it's really a very important prerequisite. And of course, having some, let's say, interoperable IT systems to build this agentic agent that could fluidify the processing. Let's say maybe the second big barrier is the human resistance. You spoke about replacement and the fear of losing a job, etc. So what we experience in the field is regularly people that want to keep the job as it is in the old way. So there will be this very important phase of onboarding people, probably using what we call crowd AI, with every single person or team developing its own agent to make sure that the technology is grasped by everyone. But still, this is one of the key important barrier I can see at the moment.
Thank you. That's good.
Well, I can add maybe time first. So as I said, we always work hard, and sometimes we don't have time to try what AI can produce. And maybe secondly, sometimes you want to try AI, you have that time, and you try to build like the full actuary AI agents. Of course, it doesn't work, and then you somehow discourage, and AI doesn't work, but just hype. So I think that's.
I think return on investment is also another thing. It's like everybody says we use AI and then we reduce the cost. And the challenge with that is that, yeah, that will happen over the long term. But if we go into 26, 27, we probably have to invest more, and we see the savings only coming a bit later. And that's with everyone's stretch is like, yeah, we're going to do that, but next year, not this year.
Also the other side of the story of people being attentive, saying, okay, things are going really rapidly and I don't know if I have to build my own agents or do I have to buy it in the market. So what I'm going to do is just wait and see what happens and then invest when the, let's say, the technology is going major. So this is also something that creates a bit of inertia in the process.
And what recommendation you would do for companies to adopt in order to successfully transition to an AI governed and controlled
use of AI.
Okay, I can go. What we on this one, how to let's say to take the problem by the, at least in my opinion, by the better or the best side, is first maybe to have a clear view in the value chain of an insurance company, a bank, and it's very different from an actor to another. Where does the AI, generative AI, has the most impact in terms of value in the chain? This is very key because it's very different from if you are an insurance company, a reinsurance company, a bank, etc. So this work of really having a clear view on the value chain and where are the spots where the AI is powerful, is effective. I think this is the very first step that should be designed, and usually by let's say executive committee, by the strategic positions of the company. Now this, let's say, being said, it does not, I mean, it's very important in parallel also to launch what we call crowd AI, to make sure that people are getting onboarded in the process, meaning, in my opinion, building proof of concept that are coming, let's say, bottom up from the teams. Is very important because it's getting them onboarded, and also it allows test the solutions on the field and see what is happening. And then maybe also to make people not breaking down the silos between the teams in the company, and fostering a common language between different skills in the insurance.
Zuhair?
Well, safe to say quite well. I think again, I would pay attention not to ask too much from AI and just go from incremental things that we were able to do. Like as I've shown, it's pretty easy to add to what we do, what we can do together, today. You can just add some unstructured data using generative AI based on pricing, monitoring, reporting, wizard, and not to ask too much. Right?
Maybe to add another angle to that, and I like the idea about the value chain. When doing these POCs, companies should also not think about, I mean, the first instance to say, where can we reduce costs? Can we use AI for efficiency? Can we do something cheaper? Can we do it quicker? I would like to turn the question around. Is there something we can do with AI we could not have done otherwise? And I think that adds up to, I mean, the video in the morning, which was quite impressive, I think. I think it was introduced with enjoy. I didn't really enjoy the pictures, but I think it was quite remarkable to see all of the catastrophes and thinking about, if we had AI, what can we do to mitigate the risk? What can we do to prevent the risk? So not starting with the efficiency, but starting what is it we as a company could do differently to what we do to close the protection gap? I think that would be a good question.
Can I open the floor for one question? Please.
Hi, my name is Wakas, and I'm from Oliver Wyman. So I've just got a very quick question. The video that you showed in the beginning for the master actuary, that was a good use case. But the question here is that, was that only based on the data of that specific company, or did it have access to the market data? So, sorry, just finishing that off. So can you answer the question, can you benchmark my loss ratio relative to the market? And if so, how do you navigate through the Data Protection Act, like the GDPR? Because that's a big thing in the European market.
So we provide two things. So we provide one LLM, which is on-premise. You have some open weight LLM, which you can use on-premise, so meaning that the data just still on your computer. It's still only locally used. We also provide a solution where you can use some big large language model. So there, we don't really need the data to be sent. Let me explain. So we saw the profitability, but actually we don't. That's not what we were looking for. What we were looking for is we have 300 jobs, and we want to group it into construction, and into some group of jobs. So we only send to the LLM all those 300 jobs, and we ask it to group it. Then the data is back to the, I would say, the local computer, and then there is locally the processing of computing the loss ratio once you know the mapping between the job and the group of jobs. And yes, so then it's an AI. So you can always ask the AI, what are the loss ratio of my competitors, for example. Then what you have now in some of the biggest large language model, they can ask the web. So they don't have it as their own knowledge, but they can check if there is like a report for some of your competitors where the loss ratio is displayed, and they can give you that information directly into the chart.
Thank you very much. Because in the European market, it's a big issue. A lot of the insurers are not allowing the normal conventional GLM models into their daily work because the consumer data cannot be shared across. So you have to have that ring fence around that. Yeah,
Thank you very much. And it's not shown there, and you can come at our booth if you want to see it more closely. But actually, there is like an option on the solution where you can see all the data that is sent to the LLM and all the data that you receive, so that you can be sure that we don't send any critical numbers, which of course would be, I would say, it's like criminal in Europe.
Well, maybe just one more information about this one, because what exists, however, is regarding the pricing and the benchmarking, is something like agents, AI agents that are capable of quoting prices on the net. So, of course, you have all these firewalls and algorithms to impeach you from doing so, but there are some cases that exist, particularly on some, let's say, comparators of prices. Of course, we will never be you will not have the best price at every single piece of the risk profile, but at least you can compare yourself in a very iterative mode, and this is the exponential, let's say, capacity of the AI. It is capable of pricing a lot of times in the net while you are sleeping at home. So this is really something very interesting in terms of benchmarking the.
Thank you. Any final thought, Frank?
Just thinking also that anti-competition, are you allowed to use the data? That's one thing. The other one is also, if you think about it, let's say you had a perfect access to all of the average prices in the entire market, all your competitors, and then you would cut out the best price, and then you put your premium out. Then it would be a paradise, but then would you think about, okay, but what are my customers? And maybe your customers tend to have higher claim costs, because you're attracting a different market segment. And then you think about, but oh, wait, but if I go out these prices, will then also my customer base change? So all of these, I mean, these are all the questions which then the AI doesn't do for you. The AI will give you numbers, will aggregate them. But to think about, is that really also applicable for me, is still something you have to work on. Yeah? You, your actuaries, your company.
Thank you all. This is the end of our session.
Thank you very much. It's been such a wonderful and very rich day. Thanks to our moderators, the speakers, and also to your engagement and your patience. You are still, all the tables are busy till 4 p.m., which is something rare in this region. We are expecting to see you again at the gala dinner at 8 for some networking and local entertainment. It will be in the same place. Tomorrow we have plenty of sessions on longevity, on actuaries in banking, on pensions, on healthcare, and lots of interesting materials. Tomorrow this room is going to be 2 rooms. Room A is going to be here, room B is going to be there. This room is going to be divided, and we will have 2 stages and 2 sessions going concurrently. See you tonight. Bye-bye.